All right, all right, all right, all right. So everyone in the class, please confirm if you people can see me, hear me or not. We are live. Everyone, is my audio there? Video there? Can you all see me? Hear me? So everyone, very, very, very welcome to this long, much awaited, in fact, revision session in full English language for this chapter of mergers and acquisitions, where we are going to learn all the concepts really well, also solve all variety of questions so that you don't have the clarity of concept, but also have a comfort on applying those concepts to the practical questions. So yes, that's what this video will be about. Yes, who all do we have in the class? Come on. Very good morning, people. Who all do we have? Aksa is here. Good morning, Aksa. Others in the class, who all do we have? So that's a full English language revision video, right? Most of the chapters were recorded in the previous attempt, which are valid even for this attempt and the coming attempt. For example, derivative, forex, IRRM, IFM, etc. chapters were being recorded in the previous attempt. In this attempt, we will record rest of the chapters. We will take the revision sessions for rest of the chapters. Like first being mergers acquisition that we are doing. Then I'm planning fixed income securities, which is I'm planning tomorrow. Then will be mutual funds, and that's how almost all the chapters, all practical chapters will be ready. Theory marathon is anyways available for you. So come on, good morning, guys. Who all do we have in the class today? Let me give you a small disclaimer before we start. Let me share my screen. People, this is just one particular chapter. I have created a playlist which has all these chapters, concept plus question revision videos, right? The link of that playlist is there in the description. Second thing, in this chapter, we are going to use two files. One is the concepts notes, calling it to be OutNotes. Another is question bank, calling it to be the OutScanner. Sir, OutNotes are the same concepts notes that we use in our regular batch, okay, which has everything presented to you in terms of tables, timeline, graphs, rather than boring text. So if you see, this is how the OutNotes, which are our concepts notes, look like. All right? So you can download the PDF of OutNotes. For now, that's freely available for downloading. Also, hard copy as of now is not available to be purchased, but I'm expecting soon I'll try to make it available. Even the OutNotes, which is the concepts notes, right? Then everyone is our question bank. Question bank, everyone, is again the same question bank that we give to our batch students, which is really comprehensive. It includes questions from RTPs, MTPs, exam paper, study material, practice manual, board of studies, knowledge portal, everywhere. Beyond this book, you won't be needed to refer to even a single question of any publication of the institute released till date. Yes. So now what the point is, sir, in this question bank, okay, I have given something called as an advanced level of ABC analysis. All right, people. When I say advanced level of ABC analysis in Hindi, we call it ABC analysis ka baap, meaning to say father of an ABC analysis. Generally, you people come across ABC analysis in which a particular chapter is considered A and a particular chapter is considered B, right? And C. For example, Forex, a lot of you people consider C, whereas you must realize that institute has really been asking the questions from Forex. Then in that case, sir, what do we do? In that case, I have given a better solution to you where in a particular chapter, some questions, some concepts are considered A, some are considered B, some are considered C. So in Forex also you have certain things as A, in derivative also you have certain things as C, correct? So that ABC analysis I have given to you for May 26, and similarly I'll keep on giving to you for every attempt. In the description there is a link of the PDF, right, which you can download, which has the markings of ABC analysis. I'll show you an example of how does the ABC analysis of May 26 look like. This is how it look like. Yes, this is how it looks like, where I have given such this marking, where I've also created what are normal questions and what are ambiguous questions and so on. Yes, now the point is, in the same OutScanner, I have marked ABC, Plain OutScanner is also available for free download. The plain question bank, this ABC analysis question bank is also available for free download. If you want, you can purchase the hard copy of the question bank. If you purchase the hard copy, the advantage is that every question has a QR code, right? So for most of the questions, when you scan this QR code, you'll be able to listen to the audio solution, look at the video solution of these questions as many times whenever you want. At your convenience, you can do it, right? So that was all, right? Just last thing before I proceed ahead. Right now, what you're seeing is this book which is applicable for May 26. It may happen that you're watching this lecture for September 26. It's very well applicable, correct? Now, in that case, the book, when you download the PDF or when you buy the book, you will get the latest OutScanner applicable for September 26. Yes. So in that case, it may happen that a sequence might vary here and there, which means it may happen that I am showing to you question number one as this, and in your outscanner which you received as the latest hard copy, it may turn out to be question number two, which is all fine. You have to make sure that you are looking at the right number. One question here and there may be fine. Yes, so that was all I wanted to tell you, everyone. So now I think we are all set, all ready to get started. People, are you all ready? Come on. Who all do we have in this live class? Come on, tell me. Are you all ready? People, please tell me. What do you all say? Yes, come on, everyone. Please. Robin, very good morning. Who else is there in this live class? Perfect. So this chapter, which is Institutes chapter number 14, mergers, acquisition, and corporate restructuring. In our outnotes, in our outscanner, this is chapter number 2, which is mergers, acquisition, and corporate restructuring. Sir, let me go to that particular page number and tell you what this chapter is about. All right. Very easy chapter, very easy chapter. Sir, in this class, this chapter to some student, they find really easy. Hello? Dave says, sir, just saw your derivative lecture, must say it should also take some teaching tips. I should also, after I call you. Yes, Dave. All right. But I'm happy that you liked the lectures. Yes. So everyone in the class, what I'm trying to tell you is that mergers acquisition a lot of students find easy because it is easy. But there is a point of confusion that a lot of students face, which is, sir, when you have to find the value of a company after merger, which means market price of a share of a company after merger, sometimes institute, sometimes the suggested answer takes simply the value of the acquirer plus the value of the target to be the post-merger market value. But sometimes institute does earnings, part of the acquirer, part of the target, whole multiplied by the PE ratio. So a lot of students sometimes is not able to have this clarity that when do you follow P into PAT into PE approach and when do you follow market value approach. Those clarities we will take, plus we are going to make sure that the learnings are so comprehensive that beyond our learnings cannot be any question. In fact, let me tell you, we will learn beyond the institute, the question that are asked by the institute. Yes. So sir, let's understand the very basic first, very basic, right? Let me open that particular thing for you. Give me a minute. Give me a minute. Let me show you the latest outscanner that we are following, latest outnotes that are following with this full English regular batch, which is right now going on. These are the outnotes of the full English regular batch, which is going on. Sir, let's learn what's happening. Let's imagine there is this company called as A Limited. A Limited is a company, right? Just one second. Anyways, so A Limited is a company which is there in the market. It is doing business. It has its own operations. It has its own assets while doing the business. It has its own earnings from the operations that it makes. It has its own EPS, and accordingly, it has its own MPS. This is a company which is there in the market. Similarly, there is one more company which is there in the market called as T Limited. T Limited has the same story. It has its own business, its own assets and liabilities, using which it performs the operation, generates the revenue, incurs the expenses, ultimately generates profit. So it has its own EPS, and similarly, it has its own MPS in the market. Correct? Fine, sir. At this point, on a particular day, it is decided that A Limited will acquire T Limited, which means A Limited and T Limited agree to this deal where A is going to acquire T. This point, this transaction, the transaction that happens at this point, we refer to it as merger transaction or acquisition transaction, right? For the purpose of AFM, the words won't make a difference. We would always mean that we have acquired the another company. So A Limited means acquiring company, T Limited means target company which is being acquired. So do you agree, after I acquire, imagine I am A Limited and imagine you are T Limited. After I acquire you, after I acquire your assets and liabilities, after I acquire your operations, will there be any assets or operation left with your company? No. Will your company even be there after merger? No. Because all your assets, liabilities, and everything has now been acquired by me. So do you agree, in my case, as an acquiring company, after I acquire you, this phase is called as post-merger phase, and before acquisition phase is called as pre-merger phase. So pre-merger, we had our individual business assets, operation, market price, earnings, everything. But after merger, your company won't even exist, and my company will have now bigger assets, because my assets which were there continue to remain mine, but your asset also become my asset now. My profit, my revenue, my income statement continue to remain mine, but your profit, revenue, operations become my revenue, profit, operations, which means now I have bigger profits. And similarly, earlier my market value was representing the ownership of my company, ownership on my assets, operations, profit. But now when your profit has also become mine, your assets have also become mine, right? can i say can I say, after merger, people in the class, after merger, your my market value will represent the value not only against my assets, my profit, but also a value against the profit and assets that I have acquired from you. We will never go to direct formulas at any point. We would want to make sure that before we proceed with the chapters, you have a background story and imagination of what we have to do in this chapter and what's happening actually. Pause. Which means after merger, I have an asset, I have the assets which will be combination of mine and yours. I will have the earnings of the company which will be the earnings of your and mine. Similarly, my market value will be the combination of mine, your market value. That's, people, how the merger transaction is. But what do we have to learn in this chapter? As a student, CA Institute will ask us question like, sir, if the pre-merger earnings of both the companies are given to us, what is going to be the earnings after merger? If pre-merger MPS of both the companies have been given to us, what is going to be the MPS after merger? And similarly for assets, this is what they will ask. Then they will take it a step ahead. Then they will ask, sir, if before merger I am a share of A Limited. A Limited before merger had an EPS, had an MPS. After merger also, that everyone share of A Limited will have an EPS, will have an MPS. So is there a change in their EPS? Is there a change in their MPS because this company got acquired at this point? So change in EPS or MPS, which means gain or loss in terms of EPS or NPS, is what you will also learn in this chapter. Similarly for T, imagine you are a shareholder of T Limited. When your share gets acquired, right? Now you have to learn it carefully. When your share gets acquired, there are two possibilities. I am an acquirer, you are a target. When I acquire all your assets and liabilities, your entire business, I have to pay you a purchase consideration in return. There are two ways I can give you that purchase consideration. One, I can give you cash, easy, which means I have purchased your shares, given you cash, now you are gone out of my company. You have basically sold your shares to me. Another possibility is when I purchase your shares, I give you the shares of my company. I will issue the shares of my company. In that case, what is the impact? The impact is that you also become the shareholder of my company, which means after merger, if you observe, after merger, we, the original shareholder of A Limited, will continue to remain. You will also be the shareholder of our company, and we will now have more number of shareholders with us. Correct? So in this entire process, let's get back to the original discussion. In this entire process, T Limited, people, we will learn each and everything in detail now. We are just making a background. So the point is, you as a shareholder of T Limited, if you were having some earnings, some market price before merger, what is your earnings and market price after merger? Is there any change? Is there a gain or loss that you have made as a shareholder of T Limited? That is what all you are going to learn in this particular chapter. People in the class, kindly respond to me with your responses. Could I give you some sense of what this chapter is going to be about? So every single student watching up this video, right? Please make sure to like the video, right? Because that really helps, that really motivates me to do more and more for you guys. So Bhagya, very good morning. Yes, everyone, we all proceed ahead. Great. So let's now really get started. Sir, let's first make sure that there are some ratios that you understand. Do you agree that earnings available to equity shareholder divided by the number of share give you EPS? But relationship between PAT and EAS is that from the PAT, when you deduct preference dividend, you get EAS, the basic format of income statement. If you feel, I can show you to you. Just a second. Here it is. Sir, if this is the format of income statement, sir, from PBT, when I pay tax, it is profit after tax. From PAT, when I pay preference dividend, what I get is earnings available to equity shareholder, because these are the earnings on which only equity shareholder has a right. Sir, if preference share in the capital structure are there, then the two numbers will be different. But imagine preference share not being there, then in that case, PAT is going to be equal to EAES. And which is the reason in the chapter of M&A, we will use the formula of EPS to be PAT divided by number of share. PAT divided by number of share. Yes. Why? Because you will observe that in this entire chapter of M&A, you would rarely, people in the class find the preference share being the part of the capital structure. So PAT divided by number of share is EPS. EPS multiplied by PE ratio give me MPS, such a basic ratio. Yes, sir. Now, if I assume this to be my LHS and if I consider it to be my RHS, can I multiply the number of share both in LHS and RHS? Yes, sir. So EPS multiplied by number of share again become PAT, and MPS multiplied by number of share become the total market value or total market cap. So the relationship can also be PAT into PE is equal to market value. So basically, equation number 1 and equation number 2 are same only, just that it is on a per share basis and this one is on a totality basis. Meaning to say, per share earning into PE gives me per share market value. Total earning into PE gives me total market value. These ratios are going to be of great help in almost every possible question. Perfect. Now, explaining to you the type of deal. When I acquire all your assets and liabilities against which I'll have to pay you purchase consideration, there are two ways to give you that purchase consideration, as I explained. On the moment I expire you, I have to pay you purchase consideration. I can either give you cash as one possibility, or I can issue the stocks of my company, the shares of my company. Sir, for you as a student, it's really important to imagine what difference does it make. The difference it makes is that, sir, at this point, when I have given you cash, It means I got your assets, I have given you the cash, you are out of the company now, right? Have I issued my shares to you? No. Which means after acquisition, will you be the shareholder of my company? No. Will you have any claim over the profits of the company, over the assets of the company, over the market value of the company? You will not have any claim in case of cash deal. But if it is a stock deal, when I acquire your assets and liabilities here, I will issue the shares of my company to you. Then in that case, my original shareholder will continue to remain the shareholder, but you will also become the shareholder. Do you agree? Now, whatever is the profit, the market value, the assets of the companies are, I will have a claim being an original shareholder. You will also have a proportionate claim. And that is why we observe that if it is a stock deal, the shareholder of T Limited has a claim over post-merger earnings and post-merger value of A Limited. They have a claim in case of stock deal, but in case of cash deal, they don't have a claim. And a point of observation. Sir, if it is a cash deal, you have been paid cash. The number of share which were previously there continue to remain the number of share, no issued shares. But if it is a stock deal, new share are issued and the number of share after merger will change. So one more thing to learn, will the number of share change in case of cash deal, not change in case of stock deal? The share of A Limited, the acquiring company limited, will change. Requesting your responses. At every step, I will need your validation if you could understand it or not. That validation helps me to understand if it is going to be if it is going in the right direction or not. Pankaj says, I have completed AFM second time few days back. Your revision video helped me to strengthen the concept. Allocated 3 more days. What should be the strategy? I'll come. Priyansh, Priyesh, Priyesh or Priyash? So Priyesh, I will come up with the strategy video separately. All right. Is your first name Janani? Janani, everyone, are you all aligned? Can we all proceed? Your response are needed, let me tell you. Okay. Your response actually decides how well this revision video will go and how frequent are we able to have the revision videos even for the other chapters. Yes. Sir, now let's learn next thing. If it is cash deal, I have to pay you a particular amount of cash. But if it is stock deal, I have to issue to you some particular number of shares. Question simply become, how do I decide the number of shares to be given to you? For that, an exchange ratio is decided. What do you mean by exchange ratio? Sir, if exchange ratio is 2 is to 1, what does it mean? It means that 1 against 2, 1 for 2. One share of acquirer will be given for every two share of the target company. So if you are a shareholder of target company, if you have two share of your company, then against your two share, one share of mine will be given. That's how an exchange ratio is decided, also called a swap ratio. This ratio helps you to understand how many shares will needed to be allotted to the shareholder of target limited. Sir, but still, how would the company decide the exchange ratio? What should be the way to decide? Let me not teach you, rather, let you only create this concept. What is the concept? My question to you. There is a company A Limited, there is a company T Limited. You are a shareholder of T, I am a shareholder of A. Every single student will have to respond to this question. Please participate. Let's imagine that being an A Limited company, my earnings per share is rupee 10. Being a T Limited, your earnings per share is rupee 5. How many shares of my company do you people think you should get against how many shares of your company for you to feel the situation to be fair? If you want if you want the situation to be fair, what do you all think against how many shares of yours you should get my shares? Come on, waiting for you to respond. In the meantime, looking at a comment. Sir, I have a question. I had your question bank I bought for Jan 26, but could have given exam due to reasons, and now I'm going. Huh? What? Random. Anyways, how many people in the class do you think? How many people? 0.5 share, or can I say against 2 share of your company you should get 1 share of my company. Apply common sense. Against 2 share of rupee 5 each, you will have 10 rupee of EPS that you are at present earning. Against that, if you get 1 share of mine, so against 1 share of mine again you get 10 rupee of EPS. So could you all understand the ratio should be 1:2 or the ratio should be 0.5? People in the class, are you all agreeing to me? So point I'm trying to make is that you have yourself figured out how do you make an exchange ratio, and then if I teach you the official formula, it is all easy. What you have done is 5 divided by 10. How do you get 0.5 or 1 by 2? 5 divided by 10. Similar thought process can also be run on market price. Imagine you are T limited, your share price is 20. Imagine I am A limited, my share price is 60. You are T limited, your share price is 20. Against how many number of shares of yours do you think you should get my how many number of shares? Yes or no? Come on. Do you feel the common sense that against your 3 shares, if you can get 1 share of mine, you will have the same value that you were earlier having. You would find the situation to be fair. So again, what you have done, 1 share of mine against 3 of yours. So 1:3 become the exchange ratio. And again, what you have done is 20 being the market price of target divided by 60 being the market price of acquirer. So formula normally become whatever parameter you take. Parameter being earnings per share, market price per share, or any other parameter. Parameter of T limited divided by parameter of A limited officially become the formula to calculate the exchange ratio. All easy, all set. My God, so many of you now. I feel motivated. Good enough. Roman is here. Devi is here. Devi, is that fine if I take only that much as your first name? Janani, is that your first name? Then Alpha, what's your full name? Bhagya is here. Aksa is here. Thank you so much, people, for a lot of you being here. So Hindi revision videos have a higher strength generally. English revision videos has lower strength, but all of you are there. I appreciate. Thank you so much. Let's make sure everyone in the class, when you are here, let's make sure we attend the entire lecture. Not only that, we attend the lecture such that we have all the concepts cleared in the class itself. We have a complete grip and command over the concepts and questions in the class itself. When you go home, you don't have to take the efforts of understanding the things again. You just have to take the efforts of revising them. Are you all there with me, with this mindset, with this determination? Come on, just confirm it once to me, please. Those who think I am there with this determination that we are going to make it 10 out of 10 in the class itself, in this video itself. Are you all there with me? Yes, there with me. So let's make those efforts in the class. Sir, this is the formula that you create if the parameter is positive. Positive parameter, everyone, is something which is considered better if it is higher. Meaning to say EPS, MPS, book value per share, these are the considered good when they are higher. Higher EPS is good, lower EPS is bad. Higher book value per share is good, lower book value per share is bad. Very similarly, negative parameters are those parameters which are considered better if they are lower. Debt to equity ratio, for example, NPA ratio. NPA ratio is a kind of bad debt ratio. You would want the bad debt ratio to be low or high? Low. So it is a negative parameter if it is considered better when it is lower, and in that case the formula reverses. The formula become parameter of acquirer divided by that particular parameter of target limited. That become the formula. So fine, sir. We have learned that how do you create the formula. 99% of the question will be this. Just 1% question randomly in the exam will be this. So you have to be very cautious while solving the question that is it a negative parameter, and then in that case the formula needs to be changed. Yes, correct. Fine, sir. Sorted, sir. Aksa says, thank you so much, sir. I am from Kerala. This helps me a lot. Yes. Come on. Alpha, please don't interfere into someone's personal thing. Where do they live? What do they do? Alpha, we have to be here for the studies. Okay. So please make sure we are focused on that. So everyone in the class, Let's understand the next thing. Sir, if there is an exchange ratio, using it, how can we determine the number of shares to be issued to the other party? That's really simple. If you have 1000 shares, if the exchange ratio is 1 is to 2, it means against your 2 share, 1 will be given. So common sense is against 2, if 1 will be given, then against 1000, how many will be given? Can you all feel? Can you all feel 500 shares? So what you are effectively doing is 1000 shares of yours multiplied by 1 by 2 being the exchange ratio tells you the number of shares to be issued. For example, sir, let's imagine the situation. I am A limited, you are T limited. So the number of share of A limited, which can officially be denoted like this even in the exam. So number of share of A limited are 40,000, number of share of T limited are 20,000. My market price is 100 to 200, your market price is 100. Let's say based on the market price, we have decided the exchange ratio to be 200 divided by 200 as 1 is to 2. So against your 20,000 shares, how many shares of mine will be issued to you? 20,000 into the exchange ratio give you 10,000 shares to be issued to you. That is one way to find the number of shares to be issued to you, which you should prefer. But there is one more way of finding it, which is the purchase consideration method. Sir, how many shares do you have? 20,000. What is the market price per share of yours? 100. Which means how much is the total purchase consideration to be received by you? Sir, 20,000 multiplied by 100 gives me 20,000 multiplied by 100 gives me 2 lakh. 20,000 into 100 gives me 20 lakh rupees to be given to you in the form of purchase consideration, because that is what your value is. That is what your value is. So if I have to give you total 20 lakh rupee of purchase consideration, how will I give that value to you? Sir, in the form of my shares. What is the worth of every share of mine? 200. My question to every single student sitting in the class is, if I have to give you total 20 lakh rupee of shares, and if my every share is worth 200 rupee, how many shares of mine will I have to give to you? 20,000, 20 lakhs divided by 200 give me, I will have to issue my share, my number of shares, 10,000 in quantity, and that's how you can also find out the number of shares to be issued. These are the two ways to find the number of shares. Requesting your responses, people in the class. How much out of 10 are you people please settled? In this second case, first we find the total purchase consideration to be given to you, which is your number of share into your market price. Then once we have the total purchase consideration, dividing it with the issue price, which is my market price, give you the number of share. Bhagya, got it. Every single student, others in the class, please come to the latest live point which is going on. Don't lag behind and respond to me. Are you all 10 out of 10 set? Now there is a point of detailing I want to touch upon here. It is a tip to solve the practical question. Sir, it may happen that your market price right now is 100. But to motivate you people to enter into this deal, I may agree to give you 120 rupee of share price. Your actual market price is 100, but it may happen that I may offer to you a share price of 120. In that case, number of share become 20,000. The purchase consideration to be given to you will become 120. And accordingly, total PC will get decided. And once you have the total PC divided by my issue price, give me the number of shares to be issued. Point of learning is, rather than market price per share, you might be given the purchase consideration that is agreed between the parties. Are you people clear with respect to everything on exchange ratio or swap ratio? Come on. Now there are three practical question tips which will avoid your mistakes and get you marks. Tip number one, please make sure that a parameter is always based, an exchange ratio is always based on per share parameter. Sir, what do you mean by it? I mean to say, can pat of target divided by pat of acquirer be the way to calculate the exchange ratio? Can market cap of target divided by market cap of acquirer be the way to calculate the exchange ratio? Answer is no. PAT or market cap are totality parameters. Exchange ratio is always based on per share parameter. Rather than PAT, you will have to use EPS. Rather than market cap, you will have to use MPS. Rather than equity shareholder fund, you will have to use book value per share. This you have to compulsorily do even if the examiner does not say anything. Am I clear with the first practical question solving tip? Second practical question solving tip. If the examiner says it is a stock deal, which means there has to be an exchange ratio, and if the exchange ratio is not given, then in the absence of information, you can assume the exchange ratio to be based on the market price per share. What per share? Market price per share. So it is always a per share parameter. It is always assumed to be market price per share. Sir, can the exchange ratio be 6 to 5? Can we have 6 share of mine against 5 shares of yours? It is very well possible. So if in case if you find a exchange ratio to be higher than 1 in any question, then please don't doubt it. It can also be higher than 1. This was everything about exchange ratio. Now you're going to very quickly learn about synergy in 1 minute. Synergy is a very simple situation. Imagine I am an acquiring company, my profit is 24 lakhs. You are a target company, your profit right now is 10 lakhs. Hello? Your profit right now is 10 lakhs. When I acquire you, our profit should collectively be 34 lakhs, my 24 plus your 10. But if in case my profit become 35 lakhs for some reason after acquisition, it means that there is a synergy of 1 lakh rupee. Simply saying over and above the summation of two individual profit, over and above the summation of two individual profit, how much is the post-merger profit? That extra post-merger profit is synergy. Calculating it as post-merger profit minus sum of individual pre-merger profit is synergy. This was an example of earning, therefore it was synergy in earnings. Similarly, you can have synergy in value. My market value is 140. Surya, give me a second. I will look at your comment. My market value is 140, your market value is 30, and people in the class, our combined market value that way logically should be 170. But if the combined market value become 190, so 20 is the additional market value which got generated, calling it to be the synergy in value. Are the two forms of synergy and their meaning and their calculation also clear to you all? Please. Because now the basics are done. Now we'll start with something which is going to be part of the exam in the form of practical questions. People, please validate, do I have the permission to go ahead, and do I have the energies to learn the things ahead? Come on. Surya, please, I mean, not now I can respond to you, but I'll respond to you. Okay, maybe on Telegram or WhatsApp. Perfect, people. Are you all ready? Are you all there? Shall we proceed? Cool. So now what I teach you is one of the most important creation of our class. This is not something which you see in institute. Guys, give me a minute. I will need to take this call. Just give me a minute. Sorry. Hello. So what I was saying to you that we have this unique creation which we have created. Not even institute teach you like this, but if you learn it like this, your concepts will be always 10 on 10 there. You have a complete clarity on this chapter. So we will proceed with it. Yes, sir. In this entire chapter, you can have the calculations based on EPS or based on MPS. When I say based on EPS, what will the calculation be? Institute will ask you that if this is E limited, this is T limited. Then after merger, what is going to be the EPS of A limited? What will it ask you? What will it ask you? Please, please, please. You need to take 1 minute extra. Okay, and you need to respond to me, what will it mean? Come on. Is it clear to you? What did I say? This chart that you're learning is the most important part of this chapter, is what I feel. Do you want me to repeat? One possibility of question is, before merger, A limited has EPS, T limited has EPS. After merger, what is going to be the EPS? That is going to be the first part, calculating post merger EPS. And then also related calculations that if there is a shareholder here, right? What is his gain or loss in terms of EPS after merger? How much has he gained or lost due to merger? Similarly, if there is a shareholder, how much is his gain or loss in terms of EPS? So that is what we are saying, it is post merger EPS and related calculation like gain loss. Then the next people in the class is post merger MPS and related calculation. Sir, the post merger MPS and related calculation means you being a shareholder of A limited, you had the market price per share of company. Similarly, someone being the shareholder of T Limited, it has a market price per share of the company. First, they will ask you, if this is getting acquired by A Limited, then what is going to be the market price after merger, calling it to be post-merger MPS. Then another part, it may ask related calculation like how much is the gain loss to the shareholder of respective companies in terms of MPS. So second part of this chapter is post-merger MPS and related calculation. Now, this post-merger MPS calculation can happen in two ways. Way one, way two. We are going to learn these ways later on. They can be done in two ways. We are going to learn them in detail later on. But whether it is post-merger EPS calculation or post-merger MPS calculation. In post-merger MPS calculation, there is way one or way two. Possibility number one or possibility number two or possibility number of three that you can face in the exam, we will learn in case of stock deal and in case of cash deal. So for EPS, we will learn cash stock. Possibility 2, we will learn cash stock. Possibility 3, we will learn cash stock. So that's how you are going to learn the 6 possibilities beyond which cannot be there any practical question. Are you people understanding how are we going to cover up this chapter so comprehensively? And you know what is the best part? We start with post-merger EPS stock deal. In this case, we learn particular 3 to 4 things, right? The flow, or you can say 5 to 6 things. But once you learn really well the flow or the rhythm of calculating those 5 to 6 things, it's really important because all your other learnings, which means EPS cash deal, post merger MPS, this case is stock and cash deal, everything will be based on the same rhythm, same thought process. So make sure that the first part which are we are going to start now, you understand it really well, because then only you'll be in the position that you create all other formulas at your own. Does that make sense? Shall we start? Sir, let's start to calculate the post-merger EPS and related calculation. So let's first look at what pre-merger data has been given. There are two companies, A and T, right? The PAT of the company 240 and 80, right? No preference, so that become EAS. The number of shares is 30,000 and 20,000. So accordingly, what are the pre-merger EPS of the company? 2,40,000 divided by 30 is 8. 80 divided by 20 is 4 being the EPS of the company. The P ratio is 8.5 and 6, and accordingly the market price is 8 into 8.5 becomes 68 and 6 into 4 become 24. This is regarding the pre-merger data given to you. Then they say synergy in earnings, meaning to say when I acquire you, my earnings will be mine. Your earnings will also become mine. But over and above that, we will have an extra profit of 1,60,000. That is what will happen in case of M&A. Now, case 1 is a stock deal when I give you the exchange ratio of 1:2. Case 2 is cash deal when I give you 45 rupees per share. We will first learn everything from the point of view of case 1, which is stock deal, and then we'll do everything from the point of view of cash deal. First and foremost learning post-merger EPS and related calculation. Can I say the simplest formula to calculate EPS will be PAT divided by number of share? What is the original formula of EPS? You know, sir, PAT divided by number of share. So in that case, can I say, if you want to calculate post-merger EPS, then you should take post-merger PAT divided by post-merger number of share. After I acquire you, after merger, what is going to be the PAT divided by what is going to be the number of share will give me the post-merger EPS. Logical? This basic, see, this is not the formula, this is not the formula, it is just our understanding. You don't have to present it to the examiner. But once you learn it this way, you will have never be needed to remember any formula. Fine, sir. So let's figure out what is going to be the PAT after merger. My PAT is mine. It will continue to remain mine. So PAT of acquirer. You, when I acquire your business, your PAT also become mine. So my PAT is mine, your PAT become mine. And synergy also become mine, because when I acquire you, I will get the advantage of synergy. So my PAT plus your PAT plus the synergy in earning is going to be the post-merger PAT divided by. My shares are there with me, they continue to remain as it is, but against your number of share, calling it to be n number of share of T limited, against your number of share there is an exchange ratio I'll have to give you. So the total number of share issued to you is number of share of target into the exchange ratio, something that we learned here, something that you learned here. Yes. So if you have 20,000 share, I'll give you the exchange ratio of 1 by 2, which means I will issue you 10,000 shares. So numerator give me the post-merger PAT, denominator give me the post-merger number of share, and automatically this is going to give me post-merger EPS. Calculation is secondary. Imagination of or the comfort over concept and creation of formula in our classes primary. Is that happening, everyone in the class? To you all, please tell me. Is that happening? Every single student watching up this video, I have a request to make. When you're watching this video, right, at any point where you feel that you are in a position now to give you the feedback, kindly comment down your genuine feedbacks. I'm not asking you to write down only positive things. But if in case you feel the video has helped you, the video has cleared your concept, the video has taught you how do you apply it in the practical question, whatever your feelings are, please comment down. It really helps me to be motivated enough to do more. Second, anyone who's a new watcher, it helps him to get a confidence that he can proceed ahead towards this video. Are you all, please, connected to me on this? Right? So you will have to, everyone in the class, wherever at any point in this video, comment down when you feel that, yes, sir, the learnings have really been helpful. Perfect, people. So I was saying, are you people comfortable with this? Yes, sir. Aligned. So now everyone in the class, next thing is, let's do the calculation. To the examiner, you don't show this. To the examiner, you don't show this. Now directly the calculation you'll have to show to the examiner. Sir, my PAT is 240, your PAT is 80. So 240 is my PAT plus your PAT 80 plus synergy in earnings, which is synergy in PAT of 160, is going to be the post-merger PAT divided by my shares of 30 will be there against your 20. I will give you the exchange ratio of 1 by 2, which means I will issue you 10,000 shares, and accordingly post-merger EPS will be how much? 2,40,000 plus 80,000 plus 1,60,000 and plus. I'm trying to also teach you the calculator simultaneously. Do it with me. 240 plus 80 plus 160 m plus. Now about the denominator. So 20,000 into 1 divided by 2 give me 10,000 plus 30,000 give me 40,000. So on my calculator screen 40,000 I can see, and in my memory is the numerator of 4,80,000. Do you agree to it? The numerator of 480 is there on my memory of calculator, and 40,000 is on the screen of the calculator. Sir, how do you solve it? In the class I have taught you all the shortcuts. We cannot go beyond the limit in this class, in this revision video, but I'll just on a lighter note guide you. I won't teach it to you right from the scratch, but those who already know the calculator shortcuts, I will guide you. 40,000 on my screen. When I press divide equal to, this 40,000 gets solved, multiplied by the memory of 4,80,000 give me earnings per share to be 12. Earnings per share to be 12. Sorted, people in the class? Sorted. So basically, when 40,000 is on the calculator screen, pressing divide equal to is like solving 1 divided by 40. So when 1 divided by 40 gets solved, what is left in the numerator is 4,80,000 to be multiplied to it. And that's how post-merger EPS is 12. Simple. Now you learn the main thing. I am a shareholder of acquirer. You listen to the main thing. I am a shareholder of an acquirer, of the acquirer. My earnings per share was rupee 8. But after I acquire you, I will continue to have one share. I was previously having one share. Even after acquisition, I will continue to have one shares because new share will be issued to you, not to me. Now on that one share, I will make a profit of EPS of rupee 12, which means, can I say, before merger my EPS was 8, but after merger my EPS has become 12. I have a gain to the shareholder of T Limited, A Limited, gain to the shareholder of A Limited. I have a gain in terms of EPS of rupees 4 share per share. And how many such shares did I have? I have 30,000 such shares. So total amount of gain in terms of my earning people in the class is 1,20,000. Aligned to me, agreeing to me on this, right? So acquirer's gain is doable. What about target? Can we have a similar thought process for you guys? You guys had an EPS of rupee 4 and now the EPS has become 12. Can we say that you have a gain of rupee 8 per share on the shares that you were holding? The answer is no. You were on your older share getting having 4 rupee of EPS. And against that old share in the new company, you get just the half of it. How many share do you get in the new company against that one older share? Only half share, which is only 0.5 share. And 12 rupees the earnings per share in the after merger. 12 rupee is the earnings per share after merger of the acquirer company of A Limited. So you don't get this one entire share in the acquiring company. Against your one older share, do you get this one entire share in the new company? No, you get only half of it. So how much is the earnings per share against only this half of the share? Sir, can I say it is 12 into half give me an earnings per share of only rupee 6, which is equal to the earnings against your one older share. Could I explain this particular part? Simple common sense. Simple common sense. Let me repeat. Let me repeat. You are having 4 rupee of EPS against your one share before merger, T Limited. Against that one older share, you had 4 rupee of earnings. In the new company, do you get that one share? In the new company, no. In the new company, you get only half of the share. So if the in the new company, if after merger per share earning is 12, what you get is not one share. Against your older one share, you get only half of it. So how much is the earning that belongs to that half of the share? People in the class, 12 is the earnings per share into the exchange ratio half give me the earnings after merger equivalent to half share, equivalent to the older one share of your company. And then can I say, sir, against your one old share, you were earning 6. Against your older share in the T Limited, you were earning 4. And now in my company, after I have acquired you, you are earning 6 on an equivalent basis. Meaning to say, against your one older share in the new company, you are earning 6. In the new company, your actual EPS is 12, but you get only half share, right? So the amount of EPS equivalent to your older one share is only 6 rupee. So sir, officially we call the 6 to be the equivalent or adjusted EPS, and the formula for that is really simple. Whatever is the post merger EPS multiplied by exchange ratio give me 6 rupee of equivalent EPS. So what you are earning is 4, but what you are now earning is 6, which means you have gained rupee 2 rupee on a per share basis. And this gain has been made on how many shares? Sir, we have made all the calculations on pre-merger number of share. So you had 20,000 such shares, right? Don't think of it again as 10,000 shares issued. No, 4 is against older number of shares, 6 is equal to the older number of shares. So gain of 2 is on older number of share to be multiplied with older number of share before merger, giving me a total gain of 40,000 rupees. Requesting your responses. Till this point, have you learned? For the acquirer, how do you calculate post-merger EPS? Equivalent EPS applicable for target, could you understand it? And the calculation of gain loss on a per unit basis, per share basis, as well as on a totality basis, both to the shareholder of A and T. Is it 10 on 10 clear to every single student? Please validate and give me a minute. I need to have water. There. Perfect. Everything is clear and understood, right? So, guys, everyone in the class, let me now, just 1 second, let me now take you all to a practical question for this. A super easy practical question where we will learn the application of the concept, right? Perfect. So let me first of all take you out to that ABC analysis file where we will do those category A questions, right? Category A questions, we also call them LDRs, the last day revision questions, which you can refer to. Because it's not possible for any student to refer to all the questions, right? So in that case, some questions have to be chosen which has a higher coverage of concepts. Fine. So here it is for you. Let's start with such a basic question. Question number one, people in the class. Let's do it. Question number one. XYZ is considering merger with ABC. XYZ limited share are currently trading at 20, has 2,50,000 shares outstanding and earnings after taxes 5 lakhs. Sir, there's this company XYZ and there's this company ABC. The two are planning to merge. Who's going to acquire who? Not clear yet. Then XYZ, the company has market price of 20, number of share 250 and earnings after tax 5 lakh. What all can you find using this? If I have earnings after tax and the number of share, I can find out EPS, and EPS and MPS, if there, I can find out P ratio. Fine, sir. These 5 parameters will always be important. PAT, number of share, EPS, PE, MPS. These 5 things you will have to always calculate. Sir, you will should be able to calculate. Sir, ABC Limited has 1,25,000 share. Its market price is 10 and earnings after tax is 125. So PAT is 125. Number of share is also 125, which means EPS is rupee 1. Cool. Market price is 10. So P ratio is also 10. The merger will be affected by means of stock swap. Wow, what a line. The merger can be a cash deal or a stock deal, but when they say it will be affected by way of stock swap, we get to realize it is a people in the class a stock deal. Cool. And ABC has agreed to a plan under which XYZ will offer current market value of ABC Limited share. Sir, this line is really important for you to know who's acquirer and who's target. ABC has agreed to a plan under which XYZ will offer current market value of ABC. If I am XYZ and if I am offering to you a value, it means that I must be buying to you, which is why I'm offering to you value. If imagine that you are buying me, imagine that you want to buy my company. So who will offer a value? Will I offer a value or will you offer me a value? It's you who will offer me a value, right? Can I offer a value? People, when you buy me, no. So when XYZ is offering a value of your current market value of ABC, which means it is XYZ who will be acquiring the ABC Limited, and that's how it become A Limited, that become T Limited. They're asking what are the pre-merger EPS and P ratio of both the companies. EPS we had calculated, PE we had calculated, it's not a big deal. Second, if ABC PE ratio is 6.4, what is its current market price? Sir, ABC, the target company, whose EPS is right now 1. If their PE ratio is 6.4, how much would the market price be? EPS into PE ratio give me MPS. So 1 into 6.4 give me market price of 6.4. What is the exchange ratio? Can I say exchange ratio if the question is silent is based on market price per share? Correct. Anyways, they have decided that we will offer to you the current market value of ABC Limited share. You can follow whichever approach. Sir, what do you mean to say by whichever approach? You can either follow this approach or this approach. The answer will be same. Correct. Correct. Sir, what I want to tell you is that we can follow the approach which is directly easy to apply. We can directly follow the exchange ratio approach. How much value we have agreed to pay them? The value equal to their market price of 6.4. Please observe, question said their market price is 10, but we are on the second part of the question where the current market price has been revised to 6.4. So the same market price we will have to continue to use. Are you all, everyone in the class, able to connect to me the tips to solve practical question? Our focus in the class is obvious to make the concepts clear, but more importantly, we have also an objective of developing that ability to apply the concepts to the practical question where students actually find that gap. So are you all connected to me? Sir, market price now to me is 6.4, which is why the exchange ratio is to be based on 6.4. So market price of target divided by market price of acquirer, 6.4 divided by 20 people in the class give me 0.32 as my exchange ratio. 0.32 is to 1 is my exchange ratio. Fine, sir. Last is what is X Limited's post-merger EPS? Post-merger EPS as a flow. My PAT plus your PAT. My PAT plus your PAT. Is there a synergy in PAT? No. My shares of 2.5 lakh plus against your 1.25 lakh, we will give you an exchange ratio of 0.32. How much does it become? Sir, 1,25,000 plus 5 lakh M plus and 1,25,000 into 0.32 plus 2,50,000 divide equal to into memory recollect give me 2.16 on a rounded off basis as the post merger EPS. Extremely easy. Post merger EPS. Extremely easy. Right? Are you doing it with me simultaneously? There's no point of looking at these things. You will have two people in the class. Do it on the calci. Come on. Then we say impact on the earnings of the shareholder. Are you all able to understand what is examiner trying to ask? Impact on the earnings, which is change in the earnings, which is gain or loss in terms of earnings. Sir, per unit on totality. If the question is silent, do both. First calculate per unit, then calculate totality. So I will say post-merger EPS of acquirer is 2.6. But is that comparable for target? No, for them we have to find equivalent. So equivalent was simply post-merger into the exchange ratio. 2.16 is post-merger EPS multiplied by exchange ratio is 0.6912. What does 0.6912 tell you? That against one pre-merger share of T Limited in the new company, how much are they getting? How much is their EPS? Against that one older share in the new company, their EPS people in the class is 0.6912. Agreed, sir. Now if the gain loss calculable, correct, sir. Their EPS was 2. For acquirer, EPS was 2, it has become 2.16. So 2.16 minus 2 become 0.16. The format is really simple, post minus pre. Post is 2.16, pre is 2, giving me the gain or loss per share as 0.16. Similarly for target, equivalent is 0.6912, whereas pre-merger was 1. So equivalent of 0.6912 minus pre-merger of 1 give me a loss of 0.3088, negative loss. These are the gain loss on a per share basis. If I multiply them with the pre-merger number of shares, right? I had 250 shares, you had 1,25,000 share. Accordingly, you get the total amount of gain loss. And that becomes the answer to this particular question. People, first question, which has so many times being the part of the exam, is it clear to you all? Everyone requesting your responses, is it clear to you all? Are you people 10 out of 10 set? Come on, tell me. What do you say? 10 out of 10 on this particular thing. Everyone? Now let's proceed ahead to the next thing. The next thing before I teach you, you will have to, everyone in the class, learn the concept. The concept now is to find an exchange ratio. What we have been doing so far, everyone in the class, is we had been given the exchange ratio. And accordingly, I was trying to find out how much the post-merger PAT be and how much according to the gain loss be. Accordingly, how much will the gain loss be? Now the examiner is not asking for the gain loss. It is trying to guide you an exchange ratio. First, we will learn break even, then we will learn maximum, then we will learn minimum. Break-even exchange ratio is a really simple situation. It is a situation where none of the parties neither have gain nor have loss. Generally, do you observe the party had gain and it had loss, right? Can we find out such an equation, such an exchange ratio where neither acquire nor target have any gain or loss? And it won't be hard for you to find such an exchange ratio, because if you don't want to have, if none of the parties want to have gain or loss, which means they want the situation to be fair. And for the situation to be fair, you have learned the formula which you yourself created, should be parameter of t divided by parameter of a. We are right now concerned about EPS. So formula will be EPS of t divided by EPS of a. For example, how much is the pre-merger EPS of T? 4. How much is the pre-merger EPS of A? 8. So the break-even exchange ratio will be 4 divided by 8, which is 0.5 is to 1, or it is 1 is to 2. But sir, that's what has actually the exchange ratio been. That has been the exchange ratio. Now let me tell you a small point of clarity. I'll need your attention. I'll need your attention now, boss. If you observe, why are the two parties gaining here? If I had my profit, you had your profit, why do you have gain after merger? Have we done new business? No. The same business gives me now extra profit. Yes, actually, it is the synergy of 1,60,000 which gets distributed between me and you as 1,20,000 and 40,000. How do you have the gain? Because in total we have a gain in terms of synergy, which ultimately gets distributed between the owners of the company. If the company makes profit, it has to ultimately reach to the shareholder, and it has reached to us like this. So if we want to create a break-even situation where none of the parties should not have any gain or loss, so if there is a synergy, there can never be have a break-even situation, first of all. So if the examiner is asking a break-even situation, which means there will not be surely any synergy. Let's solve this question assuming that there is no synergy. In that case, will the break-even be achieved? Sir, we will say the exchange ratio is 1 is to 2. We will say the exchange ratio is 1 is to 2. And now we say, let's say there is no synergy. So to the examiner, only writing this 1 by 2 will not get you marks. You will have to also justify the proof that, see, with this ratio of 1 is to 2, none of the parties is gaining and none of the parties is losing. So I will say my part of 240 plus your part of 80. Assuming no synergy now, because question will not in this case give you synergy. So my part of 240 plus your part of 80. Divide by my shares of 30 plus against your 20,000 share, I will give you a recommended exchange ratio of 1 by 2, which is based on our EPS. Give you automatically the post-merger EPS. If you calculate the post-merger EPS as 8, and if you calculate equivalent EPS, it is 4. So can I say, as an acquirer, I was earning 8 and now I earn 8. As a target, you were earning 4 and your equivalent is also 4, which means none of the parties is actually gaining anything or losing anything, which means the ratio suggested by us as a break-even ratio. Requesting everyone in the class your responses, please. Are you all able to connect to me on this? Come on, what do you say? Come on, come on, come on, come on. Everyone, I need your energies because it is just the start of the topic. We have to really learn a lot of things now. Yes. Was that initial commitment of being active and being attentive throughout the session was a mere temporary motivation, or that was your determination? Everyone, please tell me. Was that merely a temporary motivation in the moment you got blown? Or that was your actually a discipline or a determination that you will be there till the end with all your efforts and energies? Come on. Tell me, tell me, tell me. Because what you actually need for C exam is not that temporary outer motivation, but that inner drivenness, that inner discipline and determination to make it every day, to make those extra efforts every day. That is what going to make your result different from anyone else. So please keep that up. Great people, appreciable. So what I want to now tell you, please, please, please. Yeah, great, super great. Let's continue with it. Sir, how would we know if the question is a question of break even? The examiner, everyone in the class, in that case, asks you the question with these words. Tell us an exchange ratio where EPS of A Limited is maintained. That's important, huh? I'm trying to teach you how do you identify it's a break-even question. It will tell you EPS of A Limited is maintained, meaning to say A does not gain or lose. It automatically implies T also does not gain or lose. Then it says shareholder of A Limited or shareholder of T Limited are not at loss in terms of earnings. That will be another way of asking. Post-merger of EPS of A is same as pre-merger. Again, they are talking it's maintained, no gain loss. Earnings of shareholders are not diminished by the merger. Again, they are asking no gain loss. So these are the words of the question which will make you realize that they are asking for a break-even exchange ratio. This is what you will have to suggest. And after that, this is a justification you will have to give. Are we clear? So let's do one practical question of this people in the class. Super ultra fast and easy question, question number 5. I'll be very quick. M companies is studying a possible acquisition of N, right? So this is acquirer, this is target. The following data is available in respect to the companies. PAT of the company is 24 lakhs, 80 lakhs. Equity share outstanding is 4 lakhs, 16 lakh. 1 second. Is the target, is the acquirer company smaller one and the target company bigger one? M is studying a possible acquisition of N. Oh my God, we have just people in the class made a mistake. That this time the examiner was smart enough to give you the data of acquirer in the second column and the data of target in the first column. It has switched to the column. If you don't identify those things, you will end up making a mistake in the exam. Do you realize? So I will say profit after tax of M company is 80 lakhs, acquirers 80, PAT of target 24, number of shares 16.4, the market price per share 200 160. What is the present EPS? 80 divided by 16 is 5, 24 divided by 4 is 6. So acquirer 5, target 6. If the merger go by way of exchange, what is the new EPS? By exchange of equity, if the merger goes, meaning to say if it is a stock deal, what is the new EPS? But where is the exchange ratio? If the question is silent, take the exchange ratio based on MPS. Target's market price is 160, acquirer is 200, right? So 160 divided by 200 give me exchange ratio of 0.8 is to 1 or 4 is to 5. So my PAT 80, your PAT 24, divide by. My share 16 plus against your 4 lakh share will give you exchange ratio of 4 by 5. What is the post-merger EPS? People in the class, 80 plus 24 divided by 16 plus 4 into 0.8. Give me 5.4167. Or you can say 5.41. 2 digits EPS after the decimal point is sufficient unless it is a very small number. Post-merger EPS is there. Make sense? Easy, sir. C part. N wants to be sure that earnings available to shareholder is not diminished by the merger. What are they saying? Earnings should not be diminished. What is the exchange ratio? Sir, they are asking for an exchange ratio, not any gain loss. They want us to suggest an exchange ratio so that earnings are not diminished. Can you feel they are asking a break-even exchange ratio? Can anyone in the class give me how much is the break-even exchange ratio in this case? Come on. Please, please, please give me that break-even exchange ratio, people. Everyone. So break-even says, sir, EPS of target divided by they don't want earnings to be diminished. When would the earnings not get diminished? When the situation is fair. When is the situation fair? When EPS of target divided by EPS of acquirer, target's earning per share, sir, N was 6, M was 5. So will the break even be 6 by 5? The answer is yes. Can the exchange ratio is bigger than 1? Yes. So break even is 6 by 5. Will giving the answer of 6 by 5 or 1 by 2 get you marks? No, you will have to also justify. We will say my PAT 80 plus your PAT 24. Divide by my number of shares 16 plus against your 4 lakh share. This time I will give you 1.2. See, you suggested, question gave the exchange ratio of 0.8. That's not what we take now. We take the exchange ratio which we recommended as 1.2 and that gives you the post-merger EPS to be 5. Can I say my pre was 5? As an acquirer, my pre was 5, post is also 5, maintained, right? But they don't want to ask from the perspective of M, the acquirer. They want to ask it from the perspective of N. So we will say N limited, your equivalent now is 5 into 1.2, which is 6, and your pre-merger was also 6. Then which means you also don't lose anything, don't gain anything, which means it is a break even. C part of this question, is it clear to you all? Come on, everyone in the class. C part of this question clear to you all. Guys, can I ask you a question, please? Literal question to every single student sitting here. Is my language clear, understandable? The way I speak, I mean, English, different people speak in different way. Is my English smooth enough, going in a flow to you, understandable? What do you say? Come on, everyone in the class. Is that understandable? Yes, that's good enough, right? Yeah, yeah. Just wanted to confirm. I mean, I can't be taking the entire session and at the end of it, I realize that the language itself was the barrier. You cannot have it. Yeah. Is this the type of language you get to hear with all the faculties? I don't know. See, in your region, I don't know who are the other teachers and what is the way they speak. Is this the way you get to listen the things from the other faculties out there? It's comfortable, right? Cool. Thank you so much. All right. That was needed, right? So, C part of the question is clear. If you later on read part number D and E, you will observe it is the same thing asked as C, just another language. They want to ensure earnings are same as before. They want to ensure pre and post are to be same. The language of part number D and E is changed. But ultimately, it is same as part number C. Question fifth gets done. And now I'll take you to the next concept. Another brilliant concept, the concept of maximum and minimum exchange ratio. The first section in which we are right now, we are paying so much of focus and attention. You know why? Because these are the same concepts that are going to get applied in the next five possibilities. So all six possibilities of M&A will have the same thought process with minor modifications. So let's make sure that the first scenario we learn it really well. What all have you learned so far? You have learned if the pre-merger data of earnings, number of shares have been given, we can find out post-merger EPS of acquirer. For the shareholder of target, that post is not comparable, so we find equivalent. Then post and equivalent are compared. The post and the equivalent are compared with the pre-merger to find the per share gain loss, multiplying with their pre-merger number of share gives me the total gain loss. Fine, sir. Then we learned that rather than exchange ratio is given to us, if we are being told to find an exchange ratio which is break even, this is how we do it. And now we are learning maximum and minimum. Let me tell you a simple thing which will be of applicability everywhere else. People answer my question. I'm acquirer and you are target, right? Bhagya says, sir, last two attempts I couldn't clear my group despite getting good marks in AFM and audit, but this time I have a feeling that I could clear because of the classes. Bhagya, that's really great. I really wish for you, for everyone watching up this lecture, that these lectures can deliver to you the best it could. Learning, concepts, confidence, question solving, writing practice, exam tips, calcitricks, everything. And with everything which I could give, along with your consistency, your discipline efforts that you get, you really make it in the attempt that you will face. That's my wish, that's my prayer to Bhagwan, to God, that He gives you everything you deserve. Yes, and He will give you with your efforts. If you are fair to yourself, then don't worry about the results. The results are bound to fair to you. Yes. So great, great, great. Listen to me. Imagine I'm an acquirer, you are a target. We are negotiating. People in the class, please participate. This level of depth is not expected in a revision video, but still I'm interested to do it because we have the same repetition of thought process in the other five scenarios. So please participate. I'm an acquirer, you are a target company. If we are negotiating, as an acquirer, what do you think? I would want the exchange ratio to be high or low. I would want to give to you a high exchange ratio or lower exchange ratio. So obviously lower, because when I give you high exchange ratio, you will get more number of share, which is a loss to me as an acquirer. If the exchange ratio is low, I will give you lesser number of share. I will have to issue you lesser number of share, which is a good deal, which is a good thing for me. Similarly, for you as target, please this time you will have to answer. See, as an acquirer, I would want the ratio to be as low as possible. As the target, when we are negotiating, you would want the exchange ratio to be as high as possible or as low as possible. Come on. As a target, you would want the exchange ratio to be as high as possible or as low as possible. You would want to receive more and more. The more is the exchange ratio, more number of share you receive. And if you receive more number of share, accordingly your claim over the profit and the market value is more. You become a bigger shareholder of the company. That is why you would want the ratio to be as high as possible. Now you will listen to the most important line. As an acquirer, I would want the ratio to be as low as possible. As a target, you would want the ratio to be as high as possible. But do you people agree? As an acquirer, I want it to be as low as possible, but I would decide a maximum limit beyond which I cannot give you. I would want it to be as low as possible, but I will also decide a maximum limit, a maximum exchange ratio beyond which I will not give you. Similarly, as a target, you would want to be as high as possible, but you will also decide a minimum that you want in any case, below which you will not accept this deal. Yes, so that maximum that I can give you is what we need to find, and that minimum that you want is what we need to find. Point is, who gives you the maximum? The acquirer company gives you maximum. That beyond it we cannot give. We would want it to be as low as possible, but beyond this when we cannot give. As a target, you want it to be as high as possible, but below it you will not accept, is what are we going to find. And the thought process you have to now learn. The thought process. Thought process is, as an acquirer, do you people agree? Do you people agree that how can I tell this to you in short without making much noise? Is, give me a second. As an acquirer, do you agree that pre-merger EPS is rupee 8? As an acquirer, I am earning 8 rupee. After merger, if I earn 8 rupee, I am fine. After merger, if my EPS is 7, I don't enter into this deal. After merger, if my EPS is 9, then also it is fine to me. Which means, do you agree, as an acquirer, I would want that if my earnings per share before merger was 8, then after merger it should be at least 8. If it is not equal to 8, in that case, I'm not going to enter into this M&A deal. Do you agree to it or not? Because if I acquire you and after that my EPS falls to 7, what is the point of acquiring you? Do you agree? So as an acquirer, what do I want? That I can give you such an exchange ratio at max. I can give you such an exchange ratio at max that my post-merger EPS, as an acquirer, the post-merger EPS that I make is at least equal to my pre-merger EPS of rupee 8. That much of an exchange ratio I'm ready to give you. Could you understand the thought process that an acquirer is thinking, people in the class? What is acquirer saying? Acquirer saying, boss, I'm ready to give you such an exchange ratio that my post-merger EPS, which is the post-merger EPS of A Limited, is at least equal to pre-merger EPS of A Limited. Otherwise, what is the point of this deal? Sir, this understanding, if you're able to convert to math, you have already won it. Can I say my post-merger EPS is my PAT plus your PAT plus synergy in earnings divided by my shares plus against your number of share? I'll give you such an exchange ratio that using this exchange ratio, listen to my line, this is how you calculate post-merger EPS. We know that should be equal to pre-merger EPS, right? So now I will say, we are ready to give you such an exchange ratio that using that exchange ratio, when we calculate the post-merger PAT, it should be at least equal to pre-merger PAT. Could you connect to my words? It's not a formula, it is a flow. If you accept and learn, it will be of great help. Could you connect it to the flow? That my PAT is 240, your PAT is 80, and synergy is 160. My share is 30, and against your 20,000 share, we are ready to give you such an exchange ratio that using that exchange ratio, when we calculate that post-merger EPS, it should be at least equal to pre. Otherwise, there is no point of me entering into this deal. And in this entire equation, there is only one number missing, exchange ratio, that we can back calculate. Yes or no? Requesting your responses, please. Yes or no, requesting your responses, people in the class, please. So I will in that case say, sir, how do you solve it? Again, I won't teach you the calculation tricks, but for the class students who have already learned the calculation tricks, I'll just repeat it once for you so that you have a recollection of it. On the calci, we add this up. In our imagination, we bring down 8 in the denominator and we bring 30 plus 20 exchange ratio to the RHS. So the calculation become 2,40,000 plus 80,000 plus 1,60,000 divided by 8 give me 60,000. So in my imagination, I know 60 is here, which is equal to 30 plus 20 exchange ratio. So can I bring this 30 towards the LHS and deduct from 60? So minus 30,000 is, so 60 minus 30 on my calc is 30. So now in my imagination, I know 30 is equal to 20 exchange ratio. This 20 exchange ratio, which was there in the RHS, is there only. So 30 is equal to 20 exchange ratio. So 30 divided by 20 will be the exchange ratio, which is 1.5. That is how we learnt it in the class to directly solve it on the calc. Other people, those who could not understand this shortcut, it is completely fine. You can continue to follow your way of doing it. I am just trying to, on a lighter note, teaching you how can you save time, avoid writing mistakes, and directly solve the things on calc, and Institute will give you marks. Okay, okay. So, sir, this way I could find the maximum exchange ratio I'm ready to give you is 1.5 is to 1, because beyond that, if I give you, it would be my loss. Because you said, right, as an acquirer, I would want to keep it as low as possible. At 1.5, I have no loss. Beyond it, I will have a loss. Below it, I will have a profit, which is why this is my max. Agreement. Similarly, who tells the maximum target tells. So same thought process, target will apply. You will say, sir, before merger we are earning how much per share? EPS 4. After merger on your older one share you would want to earn 4. So that is what you are saying, that your post merger should at least be your pre merger. But what is your post merger? Your post merger, everyone is called as equivalent, if you realize. Do you agree to me? You would want that your equivalent should at least be equal to your people in the class pre-merger number of share. That's what you want, right? You would want that your pre-merger should at least be, your equivalent should at least be your pre-merger number of share, sir, because that the two things are comparable. Now please try to create the formula with me. You're creating the formula, don't mug it up. You will say, what is equivalent? Sir, equivalent is post multiplied by the exchange ratio. Post merger EPS into exchange ratio is equivalent. Sir, now what is post merger? My part, your part, synergy in earning, divide by my shares, and against your number of share, I'll give an exchange ratio. And whole multiplied by exchange ratio gives you the equivalent EPS that should be equal to pre-merger EPS, right? In this entire equation, only one number would be missing, which is exchange ratio, which can be found out. But before doing that math, try to feel it. Such an exchange ratio we are ready to give you. Sorry, target is saying such an exchange ratio we would want minimum. Such an exchange ratio we would want that using that exchange ratio, if you calculate the post merger EPS, and when that post merger EPS gets multiplied to the same exchange ratio again, right, it should give me an equivalent EPS which is at least equal to my pre merger EPS. That is a word form of understanding this math. This is a word form of understanding this math. And now we will say my part 240, your part 80, synergy in part 160, divide by my number of shares 30 plus against 20 will give you such an exchange ratio that post merger EPS so calculated when again multiplied by exchange ratio gives me such a post equivalent EPS that it should be at least equal to pre-merger EPS of 4 of target. And in this entire equation only one number is missing. How do you solve it? Same. Sir, 240 plus 80 plus 60 into exchange ratio divided by 4. So 240 plus 80 plus 1,60,000 divided by 4 give me 1,20,000 exchange ratio. 1,20,000 exchange ratio is equal to, in the RHS we have 30 plus 20 exchange ratio. Now this time 30 plus 20 exchange ratio. So we will bring 20 exchange ratio to the LHS. Why? Because here we already have an exchange ratio. So 120 minus 20 give you 1 lakh. Exchange ratio is equal to 30. So exchange ratio is equals to 30 divided by 1 lakh, which is 1 lakh divided equal to into 30,000 give me 0.3. Yes, again, I was not able to teach you the calculator trick. We have a shortage of time, but otherwise, if you have already learned it, it was sufficient for you to recollect. So minimum that you want is 0.3. The minimum that you want is 0.3. The maximum what I've given to can give to you 1.5. Now negotiation between the two things will happen. Boss, take your time, solve it. Except for the shortcut of the calc, you should not have any kind of discomfort. And even the shortcut calc, don't try it your way to solve. Right? I need your validation. How much out of 10? Till this topic, everyone in the class on this entire discussion. Till this point, how much out of 10 people in the class? Please kindly respond. Yes, everyone. 10 on 10 people in the class sitting here, please. All set. Good to go. Yes, perfect. So, we will solve a practical question on this part, but on a later stage, when after we have done this question of cash deal. So, are you all ready to do the cash deal? Now means. All the company data remain the same. This company data people in the class will remain the same. The only point which changes when I acquire you on the date of acquisition, the purchase consideration won't be issue of my shares. The purchase consideration will rather be paying you cash of rupee 45 per share. Do you understand what's happening? So let's again reimagine the implication of paying you cash. When I pay you cash, which means I will not issue my shares to you, which means after merger will I issue, like on the date of merger will I issue shares? No. Which means after merger will the number of share increase? No. Before merger, me as an acquirer, I had shares. I will continue to have those shares, and the company will continue to have the same number of shares even after merger, because on the day of merger, some cash was given to you. That is the first thing. Sir, which means you people as a shareholder of T Limited, will you have any claim after the merger on the EPS or the market value of the company? No. You have taken the cash and you are out of the business now. So what you have to learn, everyone in the class, please understand case 2, which is cash deal, where I pay you 45 rupees per share of cash. Let's take it to a next level. Sir, but where me as an acquirer, where will I get this cash from? Suppose my company decided to borrow this cash from the bank at the rate of 10% and the tax rate is 30%. Sir, what implication will it have? Try to imagine the implication, then the formula. Me as an acquirer, did I have any borrowing before merger? No, because I did not needed cash. I did not need cash. When on the date of merger, when I need cash, I went to the bank, borrowed it, paid it to you. So after merger, can you please feel the implication that my profit, which was previously there, will continue to remain my profit? Your profit will also become my profit because I have acquired you. But the point is, from this profit, now I have an additional cost to be borne, which is the interest cost on the borrowed amount of purchase consideration. Could you connect to me on my thoughts? The point that I want to tell you, everyone in the class, formula is secondary, understanding of the concept, understanding the background story is primary. Once you understand the primary story, the creation of concept will happen to you at your own. Please remember, the core will be there. Post-merger EPS is post-merger PAT divided by post-merger number share. That same flow we will continue. That, sir, if it is a cash deal, if you want to find out post-merger EPS, the flow will be same, post-merger PAT divided by post-merger number of share. But this time, post-merger PAT, you have to reimagine, the modification of thoughts has to happen. It is my PAT. Plus, when I acquire your business, your part is also mine. Plus, if there is a synergy, then synergy in earnings is also mine. Synergy of earnings also become mine. Correct? So my part, your part, synergy in part. Minus. There is an additional interest expense. Sir, on your whatever number of share, I have to pay you cash per share. It will give you the total amount of purchase consideration that I will borrow. So this total PC I will end up borrowing. On this borrowing amount, how much is the rate of interest per annum I'll have to pay? This much. And when I pay this interest, entire interest is not my cost, because when I pay 100 rupee of cost, 30 gets deducted from 30 saved on account of tax, and what net goes out of my pocket is only 70, right? When I pay you 100 rupee, 30 rupee of tax gets saved, and the net effect to me is only 70. So multiplying 1 minus t gives me the net effect on my profit. So my PAT plus your PAT plus synergy in PAT minus this additional expense I will bear because I have to pay the interest, give you the post-merger PAT that will be there, divided by post-merger number of share. And this time, please observe, since it is a cash deal, only my share will continue to remain because you have been paid cash, and that becomes the revised formula of calculating post-merger EPS, which I want you all to learn it as a flow, not a formula. Was I successful in doing so? Once you have this clarity, let's apply math. My part of 240, same original illustration. I would want to continue the same illustration throughout this chapter so that you have all 6 possibilities. Sir, my part of yours 240, your part of 80 plus synergy in part of 160 minus. On your 20,000 shares, I will give you 45 rupee of purchase consideration, giving me total PC. Multiplying that with 10%, multiplying that with 10% gives you, multiplying that with 10% gives you the amount of interest to be paid, into 1 minus t give you the post tax effect of tax on my profit. And that's how people we will do the calculation. 20,000 into 45 gives me 9 lakh rupee, into 10% into 70% is 63,000. Attach a negative sign to it so that you can add 1,60,000, you can add 80,000, and you can add 2,40,000. Divided by 30,000 share give me 13.9 as the post merger EPS in case of cash deal. So as an acquirer, where I was previously earning 8, now I will earn 13.9, which means on an every share basis, see what are the headings we are in. Calculating gain loss to the shareholder of A Limited in terms of earnings. I was previously earning 8, but now 13.9. I am gaining 5.9 rupee on a per share basis. Perfect. Which means on a 5.9 share, if my pre-merger number of share were 30, the total amount of gain become this. And sir, what about target? Sir, as the target you were previously earning 4. Apply common sense, people in the class. I want you all to think it. As a target you were earning 4, but after merger, do you have any claims in the earnings of acquirer? No, you have been given cash, you're out of the company. So can your 4 be compared with anything in merger, in anything with post merger? No, nothing. Which is why, sir, there is nothing called as equivalent EPS, because you don't have any claim in the earnings of the new company against your older one share. No equivalent, no gain loss, people. Could I explain? So if examiner asks you to calculate the gain loss, that simple is going to be the way. Now I'm going to teach you maximum. Maximum. Can you tell me who tells us the maximum cash per? See, this time it's not maximum exchange ratio because deal is the cash deal. So obviously I'll have to think of maximum cash per share. But you know what is the best part? Who thinks maximum, acquirer or target? Sir, acquirer. Second, the thought process remain the same. Acquirer will say, see, as an acquirer, what do you want? To give you as high cash as possible or as low cash as possible? As an acquirer, I would want to give you less. So I would want to give you a less. At the same time, I will decide a maximum limit beyond which I cannot give you. So I will say I am ready to give you such an amount of cash. I'm ready to give you such an amount of cash, such that everyone, such an amount of cash where my post merger, listen to me, I'm ready to give you such an amount of cash where my post merger EPS is at least equal to my pre merger EPS. Do you all agree to what I just said? Everyone, do you all agree to what I just said? What do you all say? Hello? People in the class, are you all agreeing to what I said? My post-merger PAT should be at least equal to my pre-merger PAT. That is what everyone in the class I'm trying to tell you. So I will say on EPS level, so I will say post is equal to pre. The thought process remain the same, but only thing that will change now is that post-merger EPS in case of cash deal, how do you calculate? Sir, this is the way to calculate. So broad logic will remain the same, but the execution of it will change because the formula has changed. We will now say post-merger PAT is like this. My PAT, your PAT, synergy in PAT. Minus that interest cost. So on your number of share, we are ready to give you such a cash per share. On your 20,000 share, we are ready to give you such a cash per share that on that total PC, when I pay an interest rate after tax, right, I get post merger PAT divided by post merger number of share, I will get post merger EPS. So such a cash per share we are ready to give you that the post merger EPS so calculated is at least equal to pre merger EPS. Hello, the post merger EPS so calculated is at least equal to pre merger EPS. Yes or no? Everyone, yes. So that is what the point is. 240 plus 80 plus 160, my part, your part, synergy in part, minus on 20,000 share, we are ready to give you such an amount of cash that on that if you pay 10% of interest with 70% of tax effect, 70% of final effect, divided by 30,000, so such a cash per share that the post merger EPS so calculated is at least equal to 8, which I was anyways previously earning. If you try to solve this entire equation, you get the cash per share of 171.42. Sir, how can we solve it directly on the calci? Really easy, really easy. Sir, before I try to teach you the numbers, please give me a confirmation on the flow, on the creation of formula, on the understanding of the concept. Could you feel that it is, could you intuitively create it? Or when I was creating, could you intuitively find the comfort on that creation? Please tell me. Waiting, people in the class, for your responses. People, please tell me yes or no. Comfortable, comfortable, right? Easy, direct, shall. Can we allow it to flow in the same way? Yes, sir. Sir, how do you do the calculation now? Sir, can this 30 gets multiplied to this 8? Yes. What does it become? 240. So can I cancel this 240 with this 240? Or in other words, can I take this 240 to RHS and deduct it from that 240 to make it 0? Yes. So sir, 80 plus 160 minus this entire bracket is equal to 0. So let's take this bracket to RHS. So it become 80 plus 60 equal to this bracket. 80 plus 60 equal to this bracket. So what's there to solve now? 80,000 plus 1,60,000 divided by 20,000 divided by 10% divided by 70% give me 171.42 is the maximum amount of cash that I can afford to pay you as an acquirer if I want to maintain my EPS. Yes. So done boss, done boss. Could you all connect to it? If you say yes, let me. Saikiran, is that your first name? Perfect. So let's now proceed to look at a practical question on this category. Sir, we have a question on this. Sir, question number 6 is a brilliant question, is a category question, but I'm not doing it for you, okay, in the class. But let me try to give you a sense of it. Boss, what I say now will make you capable of solving not just this question, but any particular question. So listen to me carefully. We know that post-merger EPS is my PAT, your PAT, synergy in PAT divided by my shares plus your share into the exchange ratios post-merger EPS. Can I say in this entire equation, Primarily, we use this formula to find out the post-merger EPS. But if in case post-merger EPS is given to me, then I can reverse calculate any of other variable which is used in this formula. Yes or no? If the examiner, if in case give you post-merger EPS, can you not back calculate the exchange ratio, which should be there to get that post-merger EPS? Can you not, people in the class, back calculate the PAT of target or the PAT of acquirer if all other numbers are given? Meaning to say, in that entire equation, if that any one particular variable is missing, you can always reverse calculate it, right? This thing, if you understand that any question of reverse calculation, you will be able to do, right? That is what is the situation. That is what the situation in this particular question 6 is, that you all must try. The question that I'll make you people do in the class right now is question number 9. Let's get to it super fast. Come on, let's get to it super fast. I will say, CEO of the company thinks that shareholder always look at EPS. Therefore, he consider maximization of EPS as the company's objective. His current net profit is 80, P ratio of 110.5. He wants to buy another firm having profit of 15.75 and PE of 10. So total profit of the company, both the company given, PE has been given. What is the maximum exchange ratio which CEO should offer so that he could keep the EPS at current level? Asking for the maximum exchange ratio. Who decides maximum? Acquirer. Is the CEO acquirer? Yes, sir. He is planning to acquire. He wants to buy another firm. So I am CEO, I am acquirer. I will decide the maximum exchange ratio. Sir, exchange ratio, not a cash deal. Yes, exchange ratio is a stock deal. So what is the thought process for exchange ratio? I'm ready to give you such a exchange ratio that my post-merger EPS is at least equal to my pre-merger EPS. Agreed. Fine, sir. Sir. So he want to maintain the EPS given the current market price are 42 and 105. Sir, as I say, first you find those 5 parameters. Sir, do you have the P ratio? Yes, sir. So accordingly, if you have the MPS and the P ratio, will you be able to find the EPS? And using EPS and the net profit of the company, will you be able to find the number of share? Uh, Total profit divided by EPS give me number of share. Those 5 things you all first of all find out, then we'll start my question to you. Maximum, who decides? Acquirer. So acquirer will say my PAT of 80 plus your PAT of 1575 divided by my shares of 20 lakhs plus against your 1,50,000 shares. I'm ready to give you such an exchange ratio that my post-merger PAT is at least equal to my pre-merger PAT of rupee 4. Creation of equation comfort. See, this table I'm not going to explain. This is basic thing, right? MPS divided by P will give you EPS. PAT divided by EPS will give you number of share. All that thing we don't do. What I want to teach you is the main thing. Could you comfortably understand what this people in the class going on? So my PAT, your PAT divided by 9 number of share plus your share into the exchange ratio will give you the post-merger EPS, which should be equal to pre of 4, right? In this entire equation, only exchange ratio is missing, which if you calculate is 2.625 is to 1, the final answer. Such a simple question it become if you realize. Next part of this question is brilliant. If the CEO wants to borrow fund at the rate of 15% and buy out the company in paying cash, do you agree? The thing has changed. Let me go to the original chart. We are in the calculation of post-merger EPS, but the first part was stock deal. Now we have to treat it like a cash deal. So now let's go to the section of cash deal. Which was the section of cash deal? Sir, this is what the cash deal was, right? Cool, fine. So what it says, if the CEO borrows the fund at the rate of 15% by paying cash, how much cash should he offer to maintain EPS tax rate 30%? How much is the maximum amount of cash I can afford to pay to you? Such a cash that my post-merger EPS is equal to pre-merger EPS. In case of cash deal, what is post-merger EPS? My PAT, your PAT. So 80 my PAT plus 1575 your PAT minus against your 50,000 share, sorry, against your 1,50,000 share, I'll give you such an amount of cash that on that total borrowing, if I if I pay 15% of interest and with the advantage of tax, the total interest if I pay this much. So the post-merger EPS should be at least equal to pre-merger EPS, where post-merger PAT divided by only my number of share of 20,000. Because to you, I am not issuing anything in the denominator. I have paid you cash in the numerator. So only my number of share continue to remain after merger, and that should be at least equal to pre-merger share of 4. Pre-merger EPS of 4. This particular thing, calculation is secondary. To be able to make the formula is primary. Could you all do it, everyone? I need a validation from every single student watching of this video. Please tell me. I need a validation. Could you have the thought process? Come on, what do you all say, everyone? Yes, cool. So now, sir, can we entirely solve it? Now, can we entirely solve it? Sir, we can. We can, right? How do you solve it? Sir, only cash per share is missing. If you find it, you get 100. This is the maximum amount of cash I can afford to pay. Question number 9. Was there a category question in which we have solved the maximum thing to be done? Correct. So first section of this entire chapter gets done where we learned that how do you calculate post-merger EPS and related calculation of gain loss, maximum, minimum, etc. in case of stock deal as well as cash deal. Now I'll take you to the post-merger MPS and related section. Are we all ready? Yes, 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 yes. By the way, out of curiosity of you guys who have been watching me, have you bought my lecture? And if no, how did you get to know about me? Have you bought my lecture, guys? And if no, how did you get to know about me? Just out of curiosity, this question is. Come on, people. YouTube revision. Saikiran, how was that? You were told by your friend. Okay. Make more such friends. So that's really interesting to know. Robin, you watched my Forex lecture 2 days back. You enjoyed it and that's why you're here today. Cool, cool, cool. Guys, I need a feedback. Just give me a second. On my table, there is a housefly, and it feels that she's about to die. Give me a minute if I can do something. Just give me a second. Just give me a second, okay? So it feels that she was struggling with her life and she was lying upside down. So I think turning her around may help her. Anyways, yeah. So Robin, regular batches are available in English. I feel bad when someone asks me so because they are available and I could not make this fact known to everyone. The teaching style is comfortable to understand. Yes. Saikiran, thank you so much. So come on, that's a great thing, people. We are moving ahead with this next section, post-merger EPS and related calculation. And this is my foundation to be online. If I get a chance to take these sessions offline, I know I can rock, because I would more like, to me, all it's a matter of how much I'm enjoying that thing, which is why I ask you to participate so that it can be my enjoyment too, right? Because then automatically my way of explaining, the energy, the efforts increases multiple fold, because then it's not a work to me. So if it is offline, the things can uh, really be significantly different. So anyways, you are learning it now. When you're participating, it make me to do more and do it happily with more efforts. We are learning the next session. Robin, you can obviously get my demo classes. They are available on YouTube. I think if you search Adish Jain, or maybe AFM regular batch Adish Jain English, something of this sort. So you have to type down AFM regular batch, you have to include my name, and you have to include English. Then you should be able to get those demo lectures, I guess. And if you don't get it, please let me know on WhatsApp compulsorily, so that I can make sure that's available to everyone. Okay. So, anyways, because a regular batch is going on live now, it's about to get over. So, anyways, good people, back to the thing. What we are now learning, post merger MPS and related calculation. What does it mean, people? What does it mean? What does it mean? It means that before merger, A Limited had an MPS, before merger, T Limited had an MPS. After T is acquired by A, T will not continue to be there, but A will continue to be there as a company. And will A have an MPS after merger? If yes, how much will it be? That is the first thing you have to calculate. And then A Limited had a shareholder who had one particular share. He will continue to have one share even after merger. So in that case, how much will his gain loss be in terms of MPS? How much similarly the gain loss be to the shareholder of T Limited in terms of MPS? So that gain loss is the related calculation. Then maximum and minimum is what you will learn in this. But now there is a catch I want to teach you. Sir, in terms of EPS, post-merger MPS and related calculation has two approaches actually. Approach number one and approach number two. Sir, if I ask you to give me post-merger EPS, what was the thought process? My pat, your pat, synergy in pat. Give you the post-merger pat. Similarly, can we have a thought for MPS as, see, I know post-merger MPS is post-merger market value divided by post-merger number of share. That is such a basic thing. Total market value divided by total number of share give you the post-merger MPS. My question to you is, can the thought for market value be? Can the thought for market value be my market value plus your market value plus synergy in market value? Will it give me the post-merger market value? The answer is yes. But this thought process of my market value plus your market value plus synergy in market value, which I am calling to be situation 2, can be applied only when examiner has given to me the information regarding post merger, has given to me information regarding synergy in value. If the examiner give me synergy in value, then I can say my value, your value, synergy in value is post-merger market value. However, if the information regarding synergy in value is not given, examiner is silent about it, can I? Is it that I assume that zero and I say my value plus your value is the post-merger market value because there is no synergy? No. If the synergy in value is missing, you cannot assume it to be zero. You have to change your approach of finding the post-merger market value. You have to find them by way of earnings. Meaning to say, you have to find the post merger market value not as my value, your value, synergy in value. You have to rather say that post merger market value is post merger patent to P. Do you agree patent to P is the market value? Yes. So if you have to find post merger pat, it is post. If you have to find post merger market value, it is post merger patent to post merger P. And what is post merger pat? Which is why I'm saying, if the market value calculation is needed, there are two ways. If the synergy in value examiner gives, examiner specifies the synergy in value, you do value plus value. If the question is silent about synergy in value, you do PAT into PE as the market value. Could you understand the first point of separation between the two approaches, the point of differentiation between the two approaches? Come on, people in the class, respond to me. Everyone. People, what do you all say? Yes. So first we will learn this entire thing where we go by way of earnings. We will learn in this the cash deal and stock deal. We will learn everything, post-merger MPS, gain loss in terms of MPS, maximum, minimum, everything. Once this section is over, then we will we will learn that if the examiner give you synergy in value, then we follow the value approach, my value plus your value plus synergy in value. So in that approach, we will learn stock deal, cash deal, and we will learn in both of these cases everything, post merger MPS, gain loss in terms of MPS, maximum, minimum. So these are the 6 possibilities you learn, which is why this revision video is way more comprehensive than how much institute has there in its study material or any other lecture which is available on the YouTube on that game, right? So what I say, people in the class, please pay attention. I will say, the situation is same. The situation is same. Pre-merger part of the company given number of share 3020, which is by EPS 8 for the P ratio 8.5 and 6, the market price 68 and 24, synergy and earnings same. So do you agree entire situation is same? Stock deal 1:2 to exchange ratio, cash deal 45, 10% rate, tax rate 30%. With this same data, this time I have to find the post-merger MPS. I will say post-merger market value divided by post-merger number of share, and the post-merger market value is post-merger PAT into post-merger PE. How do you find post-merger PAT? Really simple. My PAT plus your PAT plus synergy in PAT. My PAT, your PAT, synergy in PAT. If there is synergy in PAT, you take it. If it is not there, it can be assumed 0. See, synergy in PAT can be assumed 0, but synergy in value cannot be assumed 0, which is why you are following this alternative approach. Fine. So this into post-merger PE divided by post-merger number of share. What is post-merger number of share? My share plus against your share, I'll give an exchange ratio. That is post-merger number of share. So now everyone in the class, you have to partly realize, do you agree PAT plus synergy, my PAT plus your PAT plus synergy, divide by my share plus the share issued to you, give me something which you have already seen. Can anyone in the class try to figure out what this number is? Or can you tell me what is post-merger PAT divided by post-merger number of share? Sir, it is nothing but post-merger EPS. So is it that post-merger EPS multiplied by post-merger PE will also give you post-merger MPS? Obviously, yes. Obviously, yes. So for now, let's continue this and then I will tell you the relevance of this. So I will say my PAT 240, your PAT 80, synergy in PAT 160. Is it the post-merger PAT? Yes, sir. Multiplied by post-merger PE of 8.5. Post-merger PAT multiplied by post-merger PE of 8.5 give you the post-merger market value, and that total value is distributable to the total number of share. Sir, 30,000 are my number of share, and against your number of share of 20,000, what I give you is the exchange ratio of 1/2. Agreeing, are you all to it? What I give you is the exchange ratio of 1/2. Are you all agreeing to it? And now I say, accordingly, the post-merger MPS will be sir 2,40,000 plus 1,60,000 plus 80,000 multiplied by 8.5 M plus. Sir, how can you take it 8.5? I need post-merger PE. Please understand, will the target continue to be there after merger? No. Will the acquirer be there after merger? Yes. So after merger, what will the PE be? Examiner should specify. However, if the examiner is silent, we will say for the acquirer, if this is the merger date, then whatever is the P ratio before merger continue to remain the P ratio even after the merger. The same P continue to remain for the acquirer, and I will say 8.5 is the ratio. Then how much is the post-merger market value? 240 plus 1,60,000 plus 80,000 into 8.5 give me 40 lakhs 80,000. This total value is distributable to 40,000 share. Give me the post-merger MPS of 102. Are you all, everyone in the class, agreeing to what I'm saying? Yes. So if in case the details regarding synergy in value is not given, we have to follow the earnings approach, and the earnings approach says pat into P give you the market value, divide by number of share, give me the post-merger MPS. Sir, what was my post-merger EPS in the previous section? I calculated the post-merger EPS in the previous section, which people in the class was 12. 12 was the post-merger EPS, right? Correct. And you guys say post-merger EPS into post-merger P is also post-merger MPS. So suppose examiner has asked me to calculate post-merger EPS, which is 12. So is 12.12 into 8.5 the same number? 12 into 8.5 give you the same number of MPS, which is 102. Sorted, cool. So we have find the post-merger MPS. Now the same rhythm, gain loss in terms of MPS. As an acquirer, my MPS was 68. But now it has become 102. So please learn to calculate the gain loss to the shareholder of A and T both in terms of MPS now. Previously it was in terms of earnings, now it is in terms of their wealth, their value, their MPS. So I was previously having a market price per share of 68, but now that share price has become 102. How much I'm gaining 34 rupees on my 30,000 pre-merger number of share, giving me a total gain of 10 lakhs 20,000. But sir, similarly people in the class, for T Limited, T Limited was previously having a price of 24. Can their one per share value of 24 now be compared with 102? No. Against their one share, which was having a value of 24, in the new company, you get only half share. So you don't get one share of which has a value of 102. You get half share which has a value of 102. So what is the equivalent market price against that half share, which represent the value against their one older share? So I will say equivalent market prices post merger MPS into the exchange ratio of 1/2, giving you 51 as the equivalent MPS. 51 represents against that one older share. 51 represents against that one share of the target whose value was 24. So against that one share of target company in the pre-merger situation, right? How much is their value in the new company? So it is half of 102. It is people in the class. 51 is the value against that older share. Come on. Do you agree? Do you agree? And that is what I want to tell you, that you as a target can say previously on a per share basis we had 24, and on the same share now you have people in the class 51. So equivalent MPS 51 minus pre-merger is 24. How much you gain on a per share basis? 27. Against how many such shares? Sir, please consider to take 20,000 shares because everything is pre-merger. So number of share also has to be pre-merger, giving you a total gain of 540. So you have learned how do you calculate the total gain in terms of MPS. Sir, gain in terms of MPS per unit as well as totality. Sorted? Yes, sir. Shall we do some practical question on this category? Yes, sir. So let's start with this very first practical question, question number 10. Come on. Come on, come on, come on. Let's do this very first practical question, question number 10. Perfect. Yes, A want to acquire T Limited. Guys, please give me a go ahead. Do I have the permission to go ahead? Are you aligned with the concept such that there is no compromise in your learning? Please. Yes. So let's do it. Everyone in the class. Question number 10. Come on, people. Question number 10. Come on, people. A wants to acquire T. So this is acquire, this is T. Swap ratio is 1/2. So this is a stock deal. The question, see, in this entire chapter, where do you stand? It should be clear. You observe the swap ratio, you get it as a stock deal. Then you have to observe it is talking about EPS or MPS. So accordingly, you realize you are in the section 1 or section 2. If it is MPS, it is by way of value or by way of earnings. You have to crack everything. So A wants to acquire T. Sir, acquire clear, target clear, exchange ratios clear, PAT given, number of share given, EPS P, and the price per share before merger, pre-merger MPS given. You are required to determine the number of share to be issued by A to T. Obviously, very easy. Their number of share is right now 180, and if the exchange ratio is 1:2, I will give them 90,000 share. Very easy. What is EPS after acquisition? Post-merger EPS they are asking, not MPS, EPS. My pat, your pat, synergy in pat. So 18 plus 360, synergy in pat not given. Again, 6 lakh share. My shares plus against your 180 share, I'll give you the share at the rate of 1:2. Sir, 18 lakhs. 18 lakhs plus 3,60,000 M plus and 1,80,000 into 1 divided by 2 plus 6 lakh divide equal to into memory recollect give me 3.13 as the post merger EPS, right? As the post merger EPS. Calculation you will get with the time. At for now, your focus should not be how is sir doing the calculation tricks. Your focus should be, are you clear with the flow calculation you can also do? My part, your part divided by my shares plus against the shares of yours, some shares issued to you, 3.13 post-merger EPS. Determine equivalent EPS. Good. So post-merger EPS into the exchange ratio of 0.5 give me 1.565 as the equivalent EPS. Sir, what is the expected market price after merger if PE remain unchanged? Even if they don't say any line, this line, PE we assume to continue to remain unchanged at 10 times. So post-merger MPS. Should I apply the formula of post-merger MPS right from the scratch, or I can say EPS into PE is MPS? So sir, EPS is 3.10, 3.13. 3.13 is the EPS multiplied by 10 gives me 31.3 as the, so 3.13 multiplied by 10 give me 31.3 as the post-merger MPS, which is post-merger EPS into post-merger PE. Fine, sir. Next, market value of the merged firm. The market value of the merged firm. There are two ways to do it. One can think post-merger MPS is how much? 31.3. And how much is the post-merger number of share? Sir, per share value is this, and the number of share is 6 plus 90 as 6,90,000. That is one way to do it. But this will give you a rounded off answer, which will not be correct. Why? Because 31.3 is already a rounded off number because EPS you rounded off. So when you EPS rounded off EPS, the MPS got rounded off and automatically the market value got rounded off. Another choice is to find the post-merger market value to be directly apply the formula of post-merger pattern to PE. Sir, in the exam, what should we do? You have to do both so that examiner can take whatever it wants to. So post-merger pattern to post-merger PE give me post-merger market value. Sir, how much is post-merger pat? 18 plus 360 into how much is post-merger P? 10. So 18 plus 360 into 10 give you the same value, which will around be the same value as you calculate using first method subject to rounding of difference. So that is the market value of the merged firm. That is also clear. Next, determine the market value. That's clear. Sir, ascertain the profits accruing to the shareholder of both the companies, the gain or loss to the shareholder of both the companies. But now I have a confusion. Do you agree I can calculate the gain loss in terms of earnings as well as I can calculate the gain loss in terms of value? How much is the change in earnings is the profit in terms of earnings, and how much is the change in the market price is the profit in terms of market price? Do you understand my confusion? I'm not expecting a solution, but expecting that you understand my confusion. Come on. Do you understand my confusion? So solution is really simple. I will summarize all those confusions to you at the end because it's there in the OutNotes. But the solution is really simple, people in the class, which is wherever possible, your gain or loss should always be in terms of MPS. Wherever possible, your gain loss calculation should be in terms of MPS. So I will say I have to find out the gain loss in terms of MPS, which is really easy. Post merger MPS is 31.3. How much is equivalent MPS into 0.5, which is 15.65? All right, sir. Now let's compare pre with post. Pre merger MPS 30 and 14. Yes, sir, 30 and 14. Compared with post, equivalent is 31.3 and sorry, post-merger MPS is 31.3, equivalent is 15.65. So on a per share basis, how much is the amount of gain loss? Sir, it is 1.3 and it is 1.65. Multiplied to 6 and 1,80,000 pre-merger number of shares, give me the total gain loss in terms of value as 780 and 297. Requesting your responses are these F parts which make this question really comprehensive, clear to every single student sitting here. 10 on 10. Almost everything has been asked in this particular question, making it really comprehensive. Come on. Yes or no, guys. Now, teaching you two different things asked in different attempts by the institute. I have compiled them everything in a single question so that you can save the time by doing a single question covering multiple things. You don't have to afford time for doing different things, right? Sir, second part, which I guess was asked in one of the two attempts, and third was again asked in one of the two attempts. Sir, if you are a shareholder of T Limited holding 100 shares, will you be interested to sell your stake? I am a shareholder of T Limited. I hold 100 share, which means should I sell my stake? So as a student, I was never able to interpret what this question is. As a student means, as a teacher, if I read this question as a student, I was not able to understand what they are asking. So what they are asking, let me tell you, they are saying that you are going to acquire, so will you sell your share on the market at a price of 1400, or you will do something else? So common sense is, if we sell our share in the market, the value I get is 14 into 100 as 1400. However, rather, if we decide to get acquired, what is the per share equivalent value we will receive? 15.65. Do you agree? On your old share of 14 rupee, what you get in the new company is an equivalent value of 15.65. So on your 100 share, the value you get is 1565, which is why you don't agree to sell the share, you rather wait to get acquired so that your value increases to 1565. Second part, could I explain? Third part, after the announcement of the merger, price of T Limited rose by 10%. So 14 plus 10% give me 15.4 become the price. X, an investor having 10,000 share, having another opportunity which yield 14%. So sir, T Limited. So X is an investor, sir, who has the share of T Limited, has another investment opportunity which will earn 14%, which will yield 14%. So after the price has become 15.4, you have two choices. What are the two choices? People in the class either use this amount of 15.4 to earn 14% somewhere else, or you can get merged. You can right now you sell the share at 15.4 and earn 14% on it somewhere. Another option is that you wait to get merged and you earn something against this investment, and what you earn, people in the class, is the equivalent EPS. Do you agree? What you earn in that case is the equivalent EPS of 1.565. so if you get acquired, how much will your earnings yield be? 1.565 if you earn against an investment of 15.4, your earnings yield become 10.16. Please observe what's happening. If you earn 1.565 of equivalent EPS against the amount which is blocked of 15.4 people, you get 10.16 as the rate of return. Whereas if you invest it otherwise, you will get 14% of return, which is why it is suggested to sell these shares in the market and earn 14% somewhere else rather than being acquired. Please have this conceptual clarity. The base here is 15.4, which is the amount which got blocked. Don't take equivalent MPS as the base. Don't think 15.65 as the base. No. What you block in this case is 15.4. What you invest somewhere else is 15.4. So to make it comparable, the investment here should also be assumed 15.4 to make the base comparable. Could I make it, people in the class, clear to you? This particular question number 3, how much out of 10, everyone? Come on, tell me. How much out of 10? Requesting your responses, everyone in the class. This question was really a comprehensive question. Amit sir, Amit sir, who's a faculty himself, comes to me saying that I wish I had found such teaching during my journey, would have encoded AIRs in final two. So Amit sir, thank you so much for your message, but I know I don't doubt your intellect, your capabilities. You would anyways rank even in finals, right? As you had it in inter. So that's really great, sir. What's going on? All good, sir? Everyone in the class, please pay attention. Are you all there? Guys, you have to please respond to me on this particular question. Are you all 10 on 10? Come on. If you say yes, I can immediately take you to the next question, which is going to be another comprehensive question, making our concepts more clearer. Fine. Yes, guys. So come on. Yes. Thank you so much, sir, for bringing in some energies and a smile on my face. Yes. Thank you so much, sir. Sir, question number third, if it is clear to you, this entire question 10 gets done. 11 is a good question which has a point of learning called as value of original shareholders. I'll just give you this context, not solve the entire question. I'll just give you a context. A Limited has 30,000 shares. T Limited had 20, which with the exchange ratio of 1 by 2 become 10. So I had originally 30,000 share which continue to remain mine, and against your 20 I will issue 10. So my total share will be 40. Against in those 40,000 shares, you know how many shares are considered original? 30,000 shares. So if you ask me how much is the total market value of those original shareholder, can I say on that 30,000 share, if the per share value is 102, the total value of the original shareholder become 30 into 102, because rest of the 10 are not original. So that is what this question has asked people, the value of original shareholder, the value of those original, how many shares? Original 200. Sorry, Money and Ratnam, who's going to acquire who? Acquiring company. Money has equity share outstanding of 200, so the value against those 200 shares of acquirer is the original shareholder. Cool. 12th is fine. 13th is a great question. It has a point of learning. It is a category B question, which has a point of learning which says synergy benefit of 8%. It says, I have my PAT, you have your PAT, but when we acquire, our combined PAT will increase by 8%. That's how you get the post-merger PAT. The information regarding synergy in terms of PAT has been given, question number 13, category B question. You'll have to do it at your own. 14th is a brilliant question. We won't do it in the class, but I will give you a sense of what this question is. 14th question says, the information regarding in question number 14 is quite different. It says it has the information regarding market cap, gross profit, inventory turnover, debtor turnover, etc. things given to you. They're asking you to calculate the swap ratio based on EPS and based on MPS. Do you agree, to be able to calculate the swap ratio based on EPS, I need to have the information regarding EPS of both the companies? Has the EPS anywhere been given? No. Then how do you find EPS? By creating the income statement. And how would someone make an income statement? Sir, if you have the information regarding, sir, debtors, closing stock, can you use inventory turnover ratio, debtor turnover ratio to find the value of the debtor or the closing, to find the amount of sales or COGS? Yes. What specifically you will have to do, I'm trying to teach you here, please pay attention. Can I say debtor turnover ratio is sales, is specifically credit sales divided by debtors? Yes. So if I have the debtor turnover ratio here, and if I have the closing debtor here, can I find the credit sales? Yeah. But what do we actually need is not the credit sales, but the total sales. Which means rather than debtor turnover ratio, we will use inventory turnover ratio. But sir, inventory turnover ratio, unlike debtor turn ratio, does not have sales, it has COGS. So it's fine, right? If you have the inventory turnover ratio, if you have the amount of inventory, you can find COGS. And using COGS and using gross profit ratio, COGS, you know, is 80%. If the gross profit is 20%, you can accordingly find the total amount of sales, from which if you deduct the operating expenses of 86%, you will get the EBIT of 14%. From EBIT, pay interest, pay tax, and you have PAT divided by number of share, you have EPS. That is what you will have to do in this brilliant question. Didn't want to do entire question, but wanted to give you a sense of what this question can have. Are you all people settled with it? Please tell me. Next question we do in the class is this question number 17, which is again a comprehensive question. Could you understand? Some questions we do it entirely in the class, but some question I feel if I tell you the point of learning of that question, it become easy. Sir, how many of you feel like taking a break? Come on. How many of you feel like taking a break? Come on. After the break, the class is expected to continue for 1 hour, is my point. If you feel a need for 10 minutes or something, we can take it. But after that, 1 hour of classes again will be there. Just give me a response so that I can have an idea of what you want. People, are you all there? Needed? So let's take this 5, 7, 10 minute break. Let's take it. 11:29 right now. Let's meet back at 11:35. Settle down, right? Eat something light if you want. Okay. Then we will after again continue at 11:35. Do rest of the things after this question is done. Cool. So bye everyone. See you all after this small 5 minute break. There, everyone in the class, please. Back are we all? Shall we continue? Question 17th is, see, we have done a particular question on the concept that we've learned, right? But 17th is one such variety which, if we do, you will feel more confident in this chapter. So, shall we do it? Question 17. Following is the information regarding acquiring company Abhiman and target company Abhishek. So, there are two companies, acquiring Abhiman, target Abhishek. Fine, sir. Both the companies are promoted by multinational company Trident Limited. For both of this company, who is their promoter? This company called as Trident. So Trident is holding 50 and 60% respectively. So in Abhiman, 50% is held by Trident, and in Abhishek it is 60%. Which means rest of the 50% of Abhiman and rest of the 40% of Abhishek is held by public in general. That is a freely floating, that is a free float holding. Cool, sir. Fine. Another information is given. Share capital total of the company 200 and 100 lakhs given. Free reserves and surplus, which means reserve surplus given 800 and 500. Paid up value per share, which means kind of face value per share given. Free float market cap. The market cap, which represents this 50 and 40% part, has been given as 400 and 128 lakhs. And the P ratio of the company has been given as 10 and 4 times. All right, sir. Cool, cool, cool. That has also been given. Trident is interested to do justice to the shareholder of both the companies. For the swap ratio, weights are assigned to different parameters by board of director. What this question will try to teach you is to find an exchange ratio based on multiple parameters. They are saying you should find a exchange ratio based on book value. Is it the total book value? No, sir, always per share. Then you have to find the value as per EPS and as per market price per share. And once you have the exchange ratios found out using these three different parameters, give them these weights and find the weighted average exchange ratio. So let's first focus to find the exchange ratio based on the individual parameters. Sir, book value. So share capital plus reserve surplus give me equity shareholder fund, and equity shareholder fund divided by the number of share give me book value per share. Yes? Hello? Every other class, are you all there? Shall we continue listening to me? Hello? Back after the break, right? Sir, 200 plus 800 give me 1000 as the equity shareholder fund, and 100 plus 500 give me 600 as the equity shareholder fund, right? Dividing it with the number of share. So if the paid up capital is, share capital is 200 and per share value is 100, the number of share is 2 lakhs and 10 lakhs respectively. 2 lakhs and 10 lakhs respectively. So accordingly, equity shareholder fund divided by the number of share give me book value per share as 1000 divided by 2 as 500, 600 divided by 10 is 60. So exchange ratio based on that is target divided by acquirer, 60 divided by 500 as 0.12. Fine, sir. Cool. Based on EPS and based on MPS, do we have the possibilities to find the exchange ratio? Sir, we can make use of free float market cap. If this 400 is equal to 50%, if this 128 is equal to 28 lakhs, is equal to 40%, then how much is the total market cap? 400 divided by 50 is equal to 800, and 128 divided by 40 give me 320 lakhs as the total market cap. So if we have the total market cap and if we have the number of shares with us, can we find out the market price per share? Yes, sir. 800 divided by 2 is 400 and 320 divided by 10 is 32. So 32 divided by 400 people in the class is going to be the exchange ratio based on market price, which is 0.08. And if you have the market price and if you have the P ratio, so for example, 400 divided by P ratio give me 40 rupee of EPS and 32 MPS divided by PE of 4 give me 8 of EPS. So 8 divided by 40 give me 0.2 of exchange ratio. So I have the exchange ratio based on different parameters like this, and if I have weights, doing ratio into weight, the weighted average is 0.15 is the final exchange ratio that is to be considered based on above weights. In the first part of the question, could I make you people understand what we had to do? Come on, requesting your responses, please. Come on, come on, come on. People in the class, super ultra fast. What do you all say? Settled, aligned to me on this. Can I continue? The next everyone in the class is, what is the book value, earnings per share and the market price of Abhiman after acquisition of Abhishek, which means what they are simply asking is post merger EPS, MPS and book value per share. Sir, EPS and MPS is fine, understandable. How do you find the book value per share? So let's figure it out. Assume that P ratio remain unchanged and all the assets and liabilities taken over at book value. So P remain unchanged is a assumption right now to be considered. The second assumption we will talk about it later. Sir, what is the post-merger EPS? My pat, your pat, synergy in pat. So how much is my pat? EPS is 40, number of share is 2 lakhs. So 80 is my pat. 40 into 2, 80 is my pat. EPS is 10, 8, number of share is 10 lakhs. So 80 is your pat. So my pat 80 plus your pat 80. So the total pat become 160 divided by my shares as an acquirer 2 lakhs, and against your 10 lakh shares I'll give you an exchange ratio of 0.15. So 2 plus 10 into 0.15 give me the post merger number of share. So 10 into 10 multiplied by 0.15 plus 2 divide equal to into 160 give me 45.71 as post merger EPS. A post-merger MPS will be what? EPS into PE ratio. Assuming the PE ratio remain unchanged, the PE was 10 of the acquirer, it will continue to remain 10. So 445.71 give me 457.1 as post-merger MPS. Aligned? Agree to me? Yes, sir. Next is post-merger book value per share. So book value per share is a common sense. When I acquire all your assets and liabilities, do you agree? In my balance sheet, my assets will increase by the amount of your assets, my liabilities will increase by the amount of your liabilities, which means my equity shareholder fund will increase by the amount of your equity shareholder fund. Because what is equity shareholder funds are from these assets, if you deduct the liabilities, you get equity shareholder fund. So my balance sheet was a bigger balance sheet. If that bigger balance sheet asset increased by this, liability increased by this, then automatically equity shareholder fund increased by this. Especially when the second assumption, when I take all your assets and liabilities at as per your book value. So if your book value was 600, my book value will also increase by 600. So my at present book value is 1000, which if it increased by 600 becomes 1600 of book value in the numerator, which is 1000 plus 600. So this become post-merger book value, post-merger equity shareholder fund divided by post-merger number of share give me this. So the book value per share become 457.14. So is there a particular formula of post-merger book value of share? No. Post-merger equity shareholder of fund, equity shareholder fund divided by post-merger number of share give me post-merger book value per share. All right, everyone. The second part gets done. The third part, which is more interesting. The main point of learning in this question is the third part. Promoters revised holding in Abhiman. What they are trying to teach you is that, sir, Abhiman, which had 2 lakh shares. Abhiman, which had 2 lakh shares, 150% of which who's holding? Promoter. Sir, Abhishek, which had 10 lakh shares, 60% of which were held by promoter. Of against this 60% share, like against that every one share, what is the exchange ratio? 0.15. So how many shares will be allotted to them? Sir, 1 lakh and 10 lakh into 60% into 0.15 give me 90,000. So the total number of share they are holding now is 90,000. And how much is the number of share in total? Sir, Abhiman had 10 lakh, 2 lakh shares initially, and against 10 lakh if 0.15 are issued, which means 1.5 lakh shares are additionally issued. So 2 plus 1.5 give me, people in the class, 3.5 lakh share. 2 point plus 1.2 plus 1.5 give me 3.5 lakh shares. So out of 3.5 lakh share, if 190 is being held by the promoters originally of Abhiman and then of Abhishek, collectively is 1.9, it is 54.29% holding. People, could you all connect to me on this, requesting your responses, please? Could you all connect to me again? See, the question is typical, which is why at every step I will need your validation. So next is what is the free float market cap? So out of 350, 190 is held by promoter. So rest of 3,50,000 minus 3,50,000 minus 1,90,000 give me rest of 1,60,000 shares to be held by public in general. Shares which are held by public in general multiplied by the market price per share, which is calculated as 457.1 into 457.1 give me 7 crore 31 lakh 36,000. 7 crore 31 lakh 36,000 as the free float market cap. Logical. Last part, people in the class, is easy. You will, okay, let me do it. I thought you will look at it at your own. They say if we issue the bonus share, so if I have 3.5 lakh shares right now, if I issue 1 is to 2 bonus, which means I issue 1.75 lakh shares more, right, giving me 5.25 lakh shares in total after bonus. And if one share is split into a share of rupee 5 each, so I have one share of 100 each. If I want to convert it to share of 5 each, do you agree I have to split it into the 20 share? Because one share of 100 is equal to 20 shares of 5 each. So I'll have to convert one share into 50, 20. So total number of share will be 105 lakh after bonus and split, people in the class. So they are saying after we have done the bonus split, the number of share become how much? This much. And accordingly, how much will the EPS and book value become? Sir, the total profit does not change because of bonus or split. The total profit of 160 remain the same. The total PAT, my PAT plus your PAT, 80 plus 80. 160 divided by the number of share will now be 160 divided by the number of share will now be 105 lakhs, giving me 1.524 of EPS. And total book value again remain the same. 1600 divided by 105 lakh give me 15.24 as the book value per share. This, people in the class, completes the entire question, which was question number 17. Where point of learning, if I have to summarize, sir, learning this concept of free float market cap, converting it to total and everything. Second learning was calculating the exchange ratio using weighted average. Third, the exchange ratio has to be based on per share parameter. Fourth, calculating the post merger book value. Fifth, promoter holding and promoter revised holding. Sixth, giving the effect of bonus and split, and then finding revised EPS and revised book value per share. These are certain things which you have learned in this particular question, which is generally not the part of other question. Question number 18 is again a category question. We are not doing it in the class. The question on strong bank, weak bank, must do, because it is new to process, it is effort taking, you'll have to do it at your own. Cool. To be able to solve further question, we need to now learn further concepts. Come on. Come on. Let's go to the next concept. What it says, everyone. What it says. So guys, please pay attention. It says, it says that post merger MPS can be found by way of earnings. So you found post merger MPS, right? Then you found gain loss using equivalent as well. Fine. So now you have to learn the maximum and minimum EPS. Sir, who tells the maximum? The acquirer. Who tells the minimum? The target. But while telling maximum this time, the mindset, people in the class, is what? The mindset, people in the class, is what? The mindset is, I'm ready to give you such an exchange ratio. The same thought process, but this time in terms of MPS, I'm ready to give you such an exchange ratio that my post merger MPS is at least equal to my pre merger MPS. Boss, there we used to have the same thought process, but in terms of EPS, that my post merger EPS should be equal to pre merger EPS. That an exchange ratio, I'm ready to give you the same thought you have to apply in terms of MPS now. Are you all aligned? Why I said that the first section, if you learn it carefully, the modifications you'll be able to do, you have to again guide maximum and minimum, keeping in mind the MPS, not EPS this time. Yes, everyone, keeping in mind the MPS, not EPS this time. And now I can say, sir, my pat plus what is the formula to calculate post merger MPS? My pat, your pat, synergy in pat, multiplied by post merger P ratio, because we are calculating the post merger EPS by way of earnings. In which section are we? Sir, this is the section we are in. This is the way to calculate post merger MPS. So sir, My part, your part, synergy in part into post-merger P give me post-merger market value divided by post-merger number of share, which is my shares plus against your share, I'll give you an exchange ratio. So what is the point? What is the point? I'm ready to give you such an exchange ratio that with that exchange ratio, when we calculate the post-merger MPS, that should at least be equal to my pre-merger MPS of 68, because below that, if this the MPS, what is the point of me doing this M&A deal? Below this, if is the exchange, if the post-merger MPS, what is the point of M&A deal? My part, your part, synergy part into the P ratio, divide by my number of share 30 plus against your 20, I'll give you such an exchange ratio that post is equal to at least pre of 68. In this entire equation, only one number is missing, which we can find out. Before finding this number, are you comfortable on the creation of this equation, the thought process of this equation? Solution is secondary. I would particularly need a validation from every student watching of this lecture. Come on. I would particularly need a validation watching of this lecture. Come on, tell me. People, what do you all say? Yes or no? Creation of equation, are you comfortable? Solution we will do, it's fine. So sir, the thought process remain the same. Post merger MPS is equal to pre merger MPS. This is the formula of post merger MPS, which is equal to pre. Exchange ratio, if you have to find out, really simple. First solve this part, divided with 68, take it to the RHS, solve it simply. You will get an exchange ratio of 1.5 is to 1. Maximum, how much can the acquirer afford? 1.5. But how much is the minimum target wants? The target says our equivalent should be at least equal to pre-merger, but this time in terms of FPS. You will say our after merger value should be same as our pre-merger value. So your pre-merger value was 24 on a per share basis. So comparable to same 24, what you get in the new company is equivalent MPS on the same per share. Now you get equivalent MPS, which you want to be at least equal to 24. Correct? So now I will say equivalent is what? Post-merger MPS into exchange ratio is equal to pre-merger MPS. That's what equivalent is, right, everyone? That's how. Crack the formula. This is just the thought process you need for your understanding. To the examiner, this is step 1, this is step 2, this is a step 3. The answer is ready. Answer is ready. This is your thought process to be able to have the stepwise thinking that post-merger MPS into the exchange ratio is the equivalent MPS. Aligned, sir. That should be equal to pre-merger. Fine. What is post-merger? My part, your part, synergy in part into post-merger P. Whole divided by my share against your share. I'll give an exchange ratio. Whole multiplied by exchange ratio give you post-merger MPS. Aligned, sir. So what is the thought process? We are ready to give you such an exchange ratio. Yeah, that using that, sorry, the target wants, I'll change my words. The target wants, because I have to think it from the perspective of target. The target wants such an exchange ratio that using that exchange ratio, when you calculate post-merger MPS, and when that post-merger MPS again gets multiplied to the same exchange ratio, I get equivalent MPS that should be at least equal to pre-merger, that an exchange ratio target wants. So if I put all these numbers, 240, 80, 160 into 8.5, divide by this into the exchange ratio is equal to 2.4, right? 2.4. People in the class can give you the exchange ratio of this. Robin, I won't enter into much detail, but I can try. Robin, 240 plus 80 into 160 into 8.5 divided by 24. That much of an exchange ratio is equal to 30 plus 20 exchange ratio, right? 240 plus 80 plus 160 into 8.5 divided by 24 gives me 1,70,000. This and this has gone. 1,70,000 exchange ratio is equal to 30 plus 20 exchange ratio. Can I bring this 20 to the LHS? Because 170 ER minus 20 ER will give me 150 exchange ratio. So 1,50,000 exchange ratio is equal to this 30,000. The exchange ratio is 30 divided by 50. So divide equal to into 30,000 give you 0.2 as the exchange ratio. Got my answer, please? Hello? Robin, could I explain you how did you perform the calculator? Class people? Dhruv, आपका revision never thought these way while looking at the question. Don't have. You know what, Dhruv? I appreciate that you have written down a comment, but unfortunately, the people sitting in this class only understand English. So they won't be able to understand what you have written. But I'll narrate. Dhruv says that the revision video he has watched and he got a clarity. He never thought that this can be the way of looking at the questions and derivatives. And now he doesn't even fear for forex and derivatives. Correct, Dhruv? Is that the correct interpretation? But I'm happy ultimately that you are liking the lecture, the revision lectures. That's really great. Keep on working hard, keep on watching these things, get the best advantage. Wishing you all the best. Yes, boss. So maximum minimum is done. So let's Dhruv, I got your emotion. I could very well connect, but just out of curiosity that what will these people think, what have you returned? So इसीलिए मैंने सोचा कि एक बार इनके लिए भी डिकोड कर देते हैं. बाकी तो भाई अच्छा है, चलने दो. इमोशंस आपके 100% मुझ तक पहुंच गए. बट ध्रुव कमेंट जरूर करना इन दैट वीडियो इफ यू रियली फाउंड दैट यूजफुल. ठीक है, जो भी आपके जेन्युइन फीडबैक्स थे. ये भी कितना अच्छा कोइंसिडेंस है, आप मुझे वहां नहीं लाइव मिले तो यहाँ मिल गए, है ना? So anyways, everyone in the class, let's get to question number 20. Come on. Yes. So C and D Limited are contemplating merger with C Limited will contemplating merger in which C will acquire D. So this is acquirer, this is target. The relevant information has been given. What it says, the total earnings of the company have been given, the number of share outstanding given, EPS, P ratio, market price. So the five things that you generally need, they are given. They are asking, look at the first part of this question. What is the maximum exchange ratio? Maximum acceptable to the shareholder of C, boss. Who tells you the maximum? The acquirer, the C tells you the maximum. And you know what? There is a confusion now. Please understand my confusion. I will answer it, but please understand the confusion at least. Maximum I can think in terms of MPS and maximum I can think in terms of EPS as well. From which perspective do you have to calculate maximum or minimum is the point? Could you understand what I'm asking, people? So what my point is, sir, you have to see the same situation was there in gain loss. Gain loss can be calculated in terms of MPS and EPS. What do you have to prefer? Always prefer MPS wherever possible. However, if the data of MPS gain loss is not possible, then do EPS. That was simple. In case of maximum minimum, it's not there this is preferred or that is preferred. It's try to grab the context of the question or try to grab the context of the previous part of the question. If this part asks for post-merger MPS and then asks for a maximum ratio, then obviously maximum ratio based on MPS. If it asks for post-merger EPS or something and then asks for the maximum ratio, then it is based on EPS. Now in this particular question, they're asking for the maximum ratio if P of the combined firm is 7. Now please tell me if the P ratio is 7, which means do you agree maximum ratio as per EPS has nothing to do with P. Sir, P ratio comes into picture only when we talk about market price per share, sir. Please observe, post-merger MPS, in this entire case, P ratio comes into picture only when I talk about MPS because EPS has nothing to do, this smaller box has nothing to do with P, right? So with the information of P given to us, we can get a sense that, okay, I have to think it in terms of MPS. So maximum, if the post-merger MPS is 7, combined MPS is 7, please tell us the maximum we can afford. C will say, my post should be at least equal to pre-MPS. That's the simple thing I want to say, correct? What is post-merger MPS of C? My part plus your part, 96 plus 30, into the post-merger PE of 7 divided by my shares of 20 plus against your 14 shares. I will give you such an exchange ratio that post-merger MPS found out using this equation is at least equal to pre-merger MPS of 38.4. Math is secondary. To be able to understand the concept and to be able to apply it in a practical question is primary. Are you all able to do it? My part, your part into P, post-merger market value divided by post-merger number of share in which exchange ratio we can find out, we can reverse calculate. The calculation I'm not showing the answer is 0.212 to 1. Similarly saying, what is the minimum exchange ratio acceptable to D? Sir, who tells you the minimum? Who tells you the minimum? It is the D limited which tells you the minimum. And if the P ratio combined is 9, how much is the minimum that you want as D? D will say equivalent should be at least equal to pre-merger MPS. So it will say equivalent is pre-merger. Equivalent is post-merger into the exchange ratio. Yes, what is post-merger? My pat, your pat into the P ratio of 9 divided by my shares plus against your 14. I'll give you such an exchange ratio that post-merger MPS into exchange is the equivalent MPS, which should at least be equal to pre-merger MPS of 15. Can you feel the concept which looked really big is has an application of 3 small steps? Come on, people in the class. Post-merger MPS into the exchange ratio is equivalent MPS is at least equal to pre-merger MPS of 15. How do you calculate post-merger MPS? By way of earnings, my pat, your pat into P, post-merger market value divided by post-merger number of share. Requesting your responses, math is secondary. How much is your comfort out of 10 on the concept of maximum exchange ratio and minimum exchange ratio that I have just explained? Come on. Waiting people in the class for your responses. Please, please. Waiting people in the class for your responses. Please. How much out of 10? Please, please, please. So I guess last 30 minutes now for us to complete this entire chapter. So before solving the next question, we will have to now everyone in the class learn the next concept. People, the next concept on which very less questions are being asked is the cash deal of this scenario. Cash deal. Devi, Priya, I am happy to hear this that I could make it simple. Were you been there right from the start of the lecture? I could see it only now. So great. So everything remained the same. Please understand where in this entire chapter are we. Everything remained the same. The pre-merger data of the two companies remain the same. Only thing is, and we have to go by way of earnings only. We are in this path only where we have to do by way of earnings. My pat, your pat, synergy impact. Only thing is that this time we have a cash deal. I have to pay you 45 rupee of cash. The same story. If I pay you 45 rupee of cash, people in the class, please participate. Think on it. If I pay you 45 rupee of cash, then do you people agree that I have to borrow this amount, and borrowing this amount will incur an additional interest cost? So interest after merger, there will be an additional expense of interest which will go out. So my post merger pat will be my pat, your pat, synergy in pat, plus that interest will go out, will reduce my pat, and that particular post merger pat into post merger PE will be post merger MPS. Could you connect? Situation is same. I have to find, in case of cash deal, the same set of things. I have to go by way of earnings only. So please observe this clarity of concept. Sir, post merger MPS is market value divided by number of share. Market value has same thought process. Pat into P is the same thing, but this time the number of share will be only the share of acquirer. It is a cash deal. What you people have been paid is cash, no shares issued to you. So denominator has only my share. Observe the numerator. Post-merger pat. In case of cash deal, we have previously done my pat, your pat, synergy in pat. My or synergy in pat. But I have to now pay an interest on the borrowing. So on your number of share, I have to pay cash per share. That total purchase consideration when I borrow, I have to pay a rate of interest which after the effect of tax becomes something. This is the post-merger PAT when multiplied by post-merger PE divided, give me post-merger market value. When divided by post-merger number of share, give me the post-merger MPS. Agreement on the formula or not? I want to make sure not even a single student in this class should be able to find that, sir, this is a new formula to learn. No. You can connect these formulas to the previous learning. PAT into P is your older learning. PAT in case of cash deal is your older learning. Do you want me to go to the cash deal post-merger EPS? Come with me for a minute. Post-merger EPS cash deal, this is the formula. Post-merger EPS cash deal, this is the formula. Post-merger EPS, PAT divided by number of share, my PAT, your PAT, synergy in PAT, minus the interest after tax which got lost divided by the acquirer share. The same formula, the same post-merger PAT into post-merger P, give me the post-merger people in the class MPS. Settled, people. So now let's put the numbers. My PAT 240, your PAT 80, synergy impact 160. On your 20 shares, when I pay you 45 rupee of cash at the rate of 10% and 70%, this is the net interest cost which my income statement will have to bear. Whole PAT multiplied by 8.5 give you the post-merger market value divided by that only my number of share gives me the post-merger MPS, which is 118.15. So if you have the post-merger MPS, let's think about the gain loss. I am an acquirer. My price previously was 68, but now it has become 118.15. Do I gain in terms of value? Yes, 50.15 on 30,000 share when I gain. So the gain loss to the shareholder of A Limited become 1504500 totality, and per unit is 50.15. That is the gain loss in terms of value I have. Cool. Sir, to the shareholder of T Limited. Now, in terms of EPS, in case of cash deal, post-merger EPS, cash deal, we could not calculate gain loss. Because pre-merger you have a profit, but after merger you don't have a profit. But value, when it comes to value, the cash deal value gain loss is calculatable. Your pre-merger value was 24. Against that value, do you agree, in the new company you have not received the market price equivalent MPS, but you have received a cash of rupee 45? Do you agree to it? So in that case, we will say 45 is the post-merger, 45 is the cash you have received against your pre-merger market value of 24. So as a shareholder of Target, you have gained 21 rupee per share on those 20,000 share. It become a total gain of 420. Yes. Could you understand? Could you understand the post-merger MPS? There is no equivalent, but still there is gain loss in terms of MPS even in case of cash deal. People, institute has rare to rare asked question on this particular category of cash deal, okay, where we go by way of earnings, and it is a case of cash deal, rare question, which is why maximum and minimum I am not revising in this class. We do it in a regular batch, but the thought process is easy, same. Such a cash that post merger MPS is equal to pre, we are not doing it further. Don't think would be a part of the exam. Even if it is the same thought process will be sufficient for you to do it. Done. Next, people, is the next section. When question specifies the synergy in value, then in that case, if the synergy in value after merger, what synergy in value this will be if is given? Can't I do my value plus your value plus synergy in value? Why do I need to go by way of earnings? So that is what the original part is. If question specifies synergy in value, calculate post-merger MPS directly using pre-merger market values. However, if the question is silent, calculate post-merger value by way of earnings, which is PAT into PE. Are the two categories clear to you, boss? Not that these 6 individual formulas you should know. What are these two broad categories? Are you realizing, everyone in the class? You will be able to make the formulas, that is my assurance. Please pay attention. Now I'll take you back to the original chart. Post-merger MPS and related calculations can be done in two ways. If synergy in value is given, you do it value plus value, my value, your value, synergy in value. If the synergy is not given, then you do my earnings plus your earnings and whatever earnings into PE. This section for cash and stock deal you have done. Now you will do this section with cash and stock deal, and that is going to be the last learning for you. This section with cash deal and stock deal is what you will have to do now. Correct? Shall we all proceed, people? So let's learn synergy if value, if is given, what is the thought process? I will say. Observe the data given. There are two companies. The pre-merger data of both the companies is same. 240 profit, number of share, P, MPS all same. But this time what they have given to me is the synergy in value of 15,60,000. There are two ways I can acquire to you. Stock deal 1:2, cash deal 45, same story. Post-merger MPS I have to find. The common sense remain the same, that post-merger MPS is market value divided by number of share. The only difference is the market value, and when I find, I will not do PAT into PE. I will do my value plus your value plus synergy in value divided by my shares plus against your 20,000 share. I'll give you an exchange ratio of 1/2. So accordingly, the number of shares issued to you. So I will say 68 multiplied by 30,000 is market value of A. 24 multiplied by 20,000 is your pre-merger market value. So my pre-merger market value is this. Your pre-merger market value is this. When I acquire you, so my value is mine. Your value will also be mine, and synergy in value of will also be mine after I acquire you 1560. Divide by my shares of 30 plus 20,000 into 1 divided by 2 plus 20,000 into 1 divided by 2. Agreeing to it, people? So can I say, people, so can I say that post-merger MPS will be solving this. Give me 102 as the answer of post-merger MPS. Sir, this is one thing. Now I'll take you ahead in this. What I'll take you ahead? Sir, what are the possible ways examiner can give me data? It may happen that rather than giving synergy in value, it may directly give me the post-merger market value. Sir, life is sorted. Directly if this entire numerator is given, life is sorted. Or it may give you details using which you can directly calculate post-merger market value. Some data is given using which you can directly calculate this number, life is sorted. Similarly, synergy in value may be directly given, or you may be given some data to calculate synergy in value. Similarly, one more possibility, you are target company, right? Examiner may give you data such that your present value is right now this, but when a target, when I acquire you, I am acquirer, when I acquire you, your value along with the effect of synergy become this. So it may happen that examiner may give you market value of the target and synergy in value mixed, in which case I will have to only take the market value of the acquirer here. Could you please understand the pink stars tell you what may be the ways data may be given to us directly, or examiner may give you hint to calculate these things? Requesting your responses. This was an important point to understand. Is this value approach of calculating post-merger MPS clear? And now, if you have post-merger MPS, again the gain loss thought process. I'm an acquirer, my price was 68, it has become 102. Have I gained? Yes, sir, 34 on this share, total gain loss. Sorted. Sorted. Sir, what about target? Target, you were 24, but against that 24, have you got 102? No, sir, you've got only half share. So how much against that older one share? How much is your value in the new company? 102 into half, give me 51 as the equivalent MPS. So can I say your price was 24, which has now become 51, giving me the per share gain loss multiplied by 20,000 share, give me the total gain loss. So same thought process, copy paste, copy paste. Only the way market value got calculated has changed. Perfect. Now, let me also teach you maximum and minimum here. Let me also take, or let me first figure out before maximum minimum, do we have a question to solve on this? So you have a great question to solve here. Which is one question is question number. Let me teach you first maximum minimum. Sir, who tells you the maximum? Acquirer. And on the basis of EPS or MPS, sir, we are in the section of MPS, but this time MPS is calculated not using earnings but using value approach. So acquirers will say, bhai, take an exchange ratio. Bro, you take such an exchange ratio that my post-merger MPS is at least equal to pre-merger. Yes, post is equal to pre. But what is post this time? Not the earnings approach. Concept remain the same. The execution of that concept gets modified according to the situation. You are in the category where post-merger MPS is calculated using value, right? So my value plus your value plus synergy in value divide by my number of share, and against your share, I'll give you such an exchange ratio that at this exchange ratio, the post-merger MPS calculated using this exchange ratio is at least equal to pre-merger MPS, right, people? Is at least equal to pre-merger MPS, right? So in that case, everyone, what do you do? What do you do? My market value 68 into 30,000, your market value 24 into 20,000 into synergy in value 15,60,000. My value, your value, synergy in value, divide by. My shares 30,000. Against your shares 20,000, what do you want to get is an exchange ratio. So such an exchange ratio that this post-merger MPS is at least equal to pre-merger of 68 is the thought process. Calculation is secondary, that anyone can do who's not even watching this video can do. But you need to answer me, is the thought process 10 on 10? Come on, is this thought process which make you people create this equation is 10 on 10 or not? People in the class, what do you say? What do you say? People, everyone. Understanding, are you all? So that exchange ratio somehow you can back calculate is not a big deal. Math we will do exchange ratio is 1.5 is to 1. So you add up everything, you divide it with 68, you take this to the RHS, deduct 30 divided by 20,000 will get you the answer of maximum exchange ratio. Similarly, who tells you the minimum? The minimum is told by target. Target will say my equivalent should be at least equal to my pre-merger of 24. What is its equivalent? Post-merger into the exchange ratio is equivalent. How is post-merger found out? The value approach, my value or value synergy in value. With this approach, when you find post-merger, so logic is, we are ready to give you such an, sorry, the target wants such an exchange ratio. It's not giving an exchange ratio because it's not acquire. It's getting exchange ratio because it is target. So we are ready to get such an exchange ratio that using that exchange ratio, when you calculate post-merger MPS, and when the same exchange ratio gets multiplied to it, so that we get the equivalent EPS, MPS, that is at least equal to the pre-merger MPS of rupee 24. So my value, your value, synergy in value, divide by my shares plus the shares issued to you at this exchange ratio, multiplied by the exchange ratio again. So this equivalent MPS should be at least equal to pre-merger MPS of 24. Agreeing, are you all to it? Please. Come on. Agreeing, are you all to it? What do you say? Hello? Same rhythm, just smartness of brain is needed, smartness of your mind is needed, that okay, equivalent is post merger into exchange ratio, fine, but this time the post merger, we are talking about MPS, obviously EPS is not in the picture. How is post merger MPS calculated? Patent to PE approach or value plus value approach? Value plus value approach, simple. But now let's do a practical question so that you realize, sir, how does the practical question of it look like? I will just show you a practical question. We will not solve it. For you people to understand how do we figure out if it is if we are in the value approach or the earnings approach. There are two companies, Doom and Elrond. Market price of both the shares given number of share outstanding given the merger is expected to generate gains which has a present value of 200 lakhs. The most important line which has decided which category of MPS you belong to. Do you agree? Present value of synergy is given, which means synergy in value has been given. So do we follow patent to PE approach? No. My value, your value, synergy in value approach. Am I 10 on 10 clear on this? That how do we figure out that it is value plus value approach? Right? Similarly, one question we do in the class right now is question number 28. Sir, longitude is proposing acquire of latitude. So this is acquirer, this is a target, and it is a share exchange, which means we are in the stock deal. Fine, sir. PAT of the company 120 and 80, number of share 15 and 16, EPS accordingly 8 and 5, the P ratio is 15 and 10, market price you can calculate. Ignore synergy. Ignore synergy. The relevance of this line, the implication of this line is they say synergy in earnings and synergy in value you have to assume zero. Important line it is, boss. Synergy in earnings and synergy in value you have to assume zero, which means with this discussion, can I say the information regarding synergy in value has been given to me? And if the synergy in value has been specifically given zero, it's not that no information is there. The information is there. Examiner is not silent about it. It is very specific that it is zero, which means for post-merger MPS related calculation, I have to not follow patent to PE approach, but rather value plus value approach. Are you all ready for this? So let's observe. You are required to determine the pre-merger market value per share. Pre-merger market value really easy. Patent to PE. 18 into 15 is 120 and 5 into 10 is 15. And overall market value is number of share into the market price per share. Second part is what we are doing this question for. Sir, the maximum exchange ratio. What is the maximum exchange ratio? Longitude can offer. Who can offer the maximum? The acquirer company can offer without a dilution of EPS and MPS. You have to first suggest a maximum using EPS and then suggest maximum using MPS. For EPS, the thought process will be post-merger EPS. Such an exchange ratio that post-merger EPS is at least equal to pre-merger. Right? So let's first think EPS. Post-merger EPS is at least equal to pre-merger. So my part plus your part divided by my shares plus against your 60, such an exchange ratio that it is at least equal to 8. So my part 20, your part 80. 15 plus 16 into such an exchange ratio, it is at least equal to pre-merger EPS of 8. And in this entire equation, only one number is missing, which if you calculate gives you 0.625. Are you all able to connect the practical application of it in a question? Calculating the maximum minimum first based on EPS, which was that particular section out there, the first section. Now the same thing you have to do in terms of MPS. Sir, MPS, the thought process remains same. Post-merger MPS is at least equal to pre-merger MPS. But what is the way to calculate post-merger MPS? Earnings based or value based? Sir, synergy in value given 0, which is by value based. So my value plus your value. My value is how much? Sir, my value 1800, your value 800. So my value plus your value divided by my share plus against your share. I'll give you such an exchange ratio that this post-merger market value is at least equal to pre-merger. This post-merger MPS is at least equal to pre-merger MPS of 120 that you have already calculated. Again, in this entire equation, only one number is missing. What? The maximum exchange ratio we can afford, which everyone in the class, if you solve this 0.417 is to 1. Could I teach you how is this entire concept that you have just learned got applied? How do you calculate the post-merger market value, a post-merger MPS using value approach, and how do you do the maximum and minimum of it? And can you feel the same has got applied in this particular question number 28 that we have just done? Requesting your responses, please. Requesting your responses, please. One particular question is question number 30, which we can consider to do now. Wow, 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 wow. Perfect, guys. Brilliant. I appreciate each one of you sitting here because that's a justification or your intention for CA final. That's your validation of your determination and discipline that you spoke about in the start of the session. In fact, recorded people, if you're watching it in one go, please let me know. That's where I did it. And there will be more such revisions coming. And with this determination, I'm 100% sure one day before the exam, you will have a sense of comfort that, okay, I did those efforts then, which is why I have a relatively better level of preparation or relatively less tension in my brain regarding AFM. This I can commit 100%. Yes, so great, appreciable efforts, people in the class. Question number 30, let's get started. Yes, what it says. Long is planning to acquire tall with the following available information. Long is planning to acquire tall. This is long limited. This is tall limited. Expected earnings per share 12 and 5. Expected dividend per share 10 and 3. Sir, how come dividend randomly 10 and 3? Number of share 30 lakh, 18 lakhs. Current market price 180.50. As per an estimate, Toll is expected to have a steady growth of dividend and earnings to the tune of 6% per annum. However, under the new management, growth is likely to increase to 8%. Sir, Toll, this company, the earnings and dividends of this company grow every year by 6% per annum. Cool. When I acquire you, I'm an acquirer, your target. So, Toll Limited, when I acquire you, with the same investment, you will now grow at the rate of 8%. How many of you can feel that there is some information regarding synergy? Hello? There's some information regarding synergy. Yes. We are not able to figure out that we have to find synergy in earnings or synergy in value. This information is regarding synergy in earnings or synergy in value. Sir, when you read this line, it feels to us it is a synergy in earnings because earnings will grow by 6 and now it will grow by 8. But ultimate effect of that increase in growth is on the value. The ultimate effect of that increase in growth is on the value. Sir, how come is it synergy in value? Boss, when the question gives you the information regarding dividend per share, when the question gives you information regarding growth, you will have to remember to think of Gordon's model. Oh my God. The Gordon's model of valuation, which is d1 divided by k minus g. Yes, with the increase in growth, will the value of overall company increase? And that increase in the value is the synergy in value, which is why we have to follow the value approach. Requesting your responses, as I said, whether these details may be directly given, or the ways to calculate them may be given. Do you agree? In this case, at the rate of 7%, which is the current growth rate, target has a value, but when the growth increases to 8%, right, the market value then found out will be inclusive of synergy effect and inclusive of the existing market value of the target. Acquirer remain as it is. There is no synergy, like there is no additional profit happening to acquirer. But when I acquire target, it will start to grow by 8, then 7. So that increase in the value due to change in growth automatically will include both of them. Yes. For example, sir, how much is the how much? So let's find out. Don't look at part number A, it will rather confuse you. Now let's look at part number B. Just a second. So let's say, we say, if the agreed exchange ratio is 1 is to 3, 1 is to 3 is the exchange ratio. Ignore this line. What will be net cost of acquisition? If the exchange ratio is 1 is to 3, right, ignore this line. What is the net cost of acquisition? For now, please change my word. Please change what they are asking. What will be gain to total? Please change the question for now. I will re-explain the original question. Question is, if the exchange ratio is 1 is to 3, what is the gain to total? What are they asking? Gain to total limited. Gain in terms of earnings or value, people, where in this entire chapter you have to please realize. Now you have learned all 6 possibilities. I'll take you to the original chart and make you people understand where in this entire chapter you are. Please. Let's do it one by one. They are asking if the agreed exchange ratio is 1 by 3. So do you first of all agree whether it is this or this or this, it is a stock deal? First. Second, gain to toll limited. Do you agree that if you have to follow the value approach, you can anyways not calculate the gain loss in terms of earnings. You have to always prefer the gain loss in terms of value. And in terms of value, whether earnings based value or the value based value, sir, value based value, because synergy in value information has been given. So you have to do stock deal, value, and you are in terms of MPS. Could you understand how do I figure out where in this entire question you are? Requesting your responses. Hello? So fine. I have to follow value plus value approach. My value plus your value plus synergy in value. Cool. Sir, now acquirer value is given. 180 being the share price, number of share being 30 lakhs. What is your value? My value is fine. What is your value? Sir, your value is 50 into 118 lakhs. But what is synergy in value? Sir, now we have to learn in this particular case, how do you apply Gordon's model? Please learn it. Sir, Gordon model says d1 divided by k minus g. If d1 dividend is 3, ke, I will find out minus growth if I make it 8%. Do you agree the value so arrived by this formula is the increased value of the target with the effect of synergy? Because 8% is the growth after the effect of synergy, so the value so arrived will also be the value with the effect of synergy, which means if I have k, I'll be able to find the market value of t with the effect of synergy directly using this formula. Could you connect to this particular line, everyone, that I'm saying? Sir, so how do we find it out? K, sir, using the present market price, using the present growth of 6%, and using the present dividend of 3, can we find the present K? Can I say d1 divided by p0 plus g is K? How much is my d1? d1 people in the class is 3. P0 is 50 plus growth is 0.06. So 3 divided by 50 is 0.06 plus 0.06 give me 12% as my KE. So the same 12% KE with this higher growth rate of 8%. So 3 divided by 12 minus 8 is 0.04 give me 75 people in the class as the revised market price rather than 50. 75 includes 50 rupee of original cost plus 25 rupee of synergy in value. So can I now say post-merger MPS I need, because using post-merger MPS, since it is a stock deal, I will need equivalent MPS, and using equivalent MPS and pre-merger MPS, I will be able to calculate the gain to the toll. So sir, let us proceed. Are you able to connect? I'm in the stock deal, not in the cash deal, right? So I'll be like, sir, my value, which is how much? My value is 180 into 30 lakhs. Your value plus synergy in value, which is 75 into 18 lakhs. Your value plus 75 into 18 lakhs divided by my number of share of 30 lakhs plus what we give to you is 6 lakhs. Sir, how is that 6 lakh? Against your 18 lakh share at the ratio of 1 is to 3, which is given in the B part of the question, we give you 6 lakh share. So accordingly, what the post-merger MPS will be? Answer is secondary. Could you connect the thought process? Everyone requesting your response, please. Yes, everyone. Are you all able to connect? You all said yes, which is really great. Sir, now the calculation is easy. My value plus your value plus synergy in value divided by my shares plus the shares issued to you will give you the post-merger MPS, which turns out to be 187.5. After I acquire you, the value become 187.5. So for the acquirer, gain become easy. Acquirer says my value of 180 become 187.5, but the target cannot say my value of 50 become 187.5, because against that one share, what you get in the new company is one third. So what is the equivalent MPS? 187.5 into 1 by 3 give you equivalent MPS of 62.5, and gain loss to the target is comparing 50 and 62.5. So 62.5 minus 50 give you 12.5 against your 18 lakh shares. It is 2 crore 25 lakhs is the overall gain to the target company. Requesting your responses. Is it clear? Right. One more illustration than the previous one we have done. Then gain from the acquisition. This part we will do later. Now you understand the next concept. The next concept people is going to the cash deal now. Sorry. Learning the last thing, people should take around 10 minutes going to the cash deal. We have to follow the value approach. We have to follow the value approach. My value plus your value plus synergy in value. Sir, if it was stock deal, right? Try to create the formula. If it was stock deal, my shares were there. And when I issued more shares, I issued you also the share, it became the number of share in the denominator. But if it is a cash deal, will I give you anything in the denominator? No, no shares. But will I give you the cash? And when I pay you cash, as an acquirer, I had a value. Post merger, I will continue to have that value. But if cash I give you, will the amount of cash fall from my bank account? Will the amount of cash go out of my assets? Accordingly, will the value of the company fall by the amount of cash? So my value is mine, your become mine, synergy become mine, but from this value, the amount of cash when it goes out, the value of the company falls by that amount, right? So that become the revised formula, everyone in the class. The formula is my value, your value, synergy in value minus the total cash purchasation paid to you. How much is the total cash paid to you? cash per share that I have to pay you, multiplied by your number of share, whole divided by only acquirer's share. So for example, 68 into 30 my value, 24 into 20 your value, 1560 synergy in value minus against your 20,000 share when I pay you 45. This is the post-merger market value now. Logic is same. Post-merger MPS is post-merger market value divided by number of share. But this time the post-merger market value in case of cash deal require the cash to go out. My cash, my value, your value, synergy in value. I am following the value approach. That is also fine. Minus the cash that I've paid out divided by only my number of share. So a small modification is what the six possibilities have. The original thought process continue to remain intact, and that's how you get the post-merger MPS to be 106. Now, sir, there is no equivalent since I've paid you cash. In the post-merger MPS, you don't have any claim, but the gain loss will be there. My value of 68 become 106, there is a gain. Your value of 24, there is no market value, but you get a cash of 45. You get a cash of 45, accordingly you also have a gain, that is also fine. Now thinking maximum minimum, who decides max? Acquirer. He will say max cash per share, how much can we give you? Such a cash per share that post merger MPS equal to pre merger. Common sense. So how do you calculate post merger in this case? Is it a pat into PE approach? No, it is a value plus value approach. So while doing the maximum minimum, figure out where in that entire chapter you are. Accordingly, the formula of post-merger MPS will get decided. Where in that entire chapter you are, accordingly the post formula gets decided, right? Are you understanding my point? Yes. So then we say, now we say, my value plus your value plus synergy in value. But it is a cash deal, so I have to pay you on your number of shares some amount of cash. So such an amount of cash we are ready to pay you that by after paying that cash, whatever market value is left when divided by acquired number of share, we get such an market price per share that it is at least equal to pre-merger MPS. Do you people agree? No new logic to learn. The same logic gets applied, right? The way you have to calculate post-merger MPS gets decided on where in this entire chapter you are. You are in this section, apply this, which should be at least equal to pre. So my value, your value, synergy in value minus such a cash per share against your 20,000 share divided my share is equal to 68. You back calculate, you get 102. Minimum is extremely easy. Let me ask you this question. People in the class, please participate. If you are a shareholder, your share price is 24. How much minimum cash do you want from me? How much is the minimum cash you would want to receive from me if you are a shareholder of T? Can I say, if you are a shareholder of T who has a price of 24, then you would want to at least receive that market price of 24. So minimum in case of cash deal is simply the market price itself. Minimum in case of cash deal, the market price itself. Second, in case of cash deal, for the target, the gain loss calculation simply is very easy. Listen to this important line. In case of cash deal, the post-merger MPS calculation is not needed because 106 is used here. Here simply the cash of 45 that you received is used. Understanding my point? That is what the learning is. Now we do the first part of this question. And before doing first part of this question, let me explain to you one more thing, a terminology actually. Something you already know, you just have to learn the terminology. Do you agree gain or loss was in terms of earnings as well as value? Earnings, profit based, value, MPS based. So the gain or loss, which is in terms of value, that was per unit in totality, MPS versus total value. So I'm talking about totality. So to the shareholders, in terms of value, if there is a gain or loss, it has an alternative terminology. A Limited, who's an acquiring company. The gain of A Limited is also called as NPV of the merger to A. What is it also called as? NPV of the merger to A. Similarly, in terms of value, the gain which is there to T Limited, your gain is called as cost of merger or cost of takeover or cost of acquisition to A. My gain is my NPV, but your gain is my cost is the alternative terminology. People in the class, you should be able to understand. Is my point clear? Nothing new to learn, just the terminology to process. Gain loss calculation, you already know. You just have to process the terminology. For example, in the B part of this question, they ask net cost of acquisition. How much is the cost of acquisition to the acquirer? The gain of the target company, which is why in this particular part, B part, we calculated the total gain to Toll Limited, which is the acquiring the target company, right? Which what net cost of acquisition. Align to me on this. In the first part, they are asking, calculate the net cost of acquisition again by long. So cost to long is the gain to target, which is toll. If 60 rupee is paid for each share of toll, which means it is a cash deal. What you are paying this time is 60 rupee. How do you know it is a cash deal? First, when they say 60 rupee gets paid, the natural interpretation is it is paid in cash. And second, in the second part, they are making it clear, if the agreed exchange ratio is 1:3 in lieu of cash deal in the first part above, rather than cash deal in the first part above, in the second part, if it is stock deal, we have clear. But in the first part, if it is cash deal, paying you cash. Do you agree? If it is a cash deal, if it is a cash deal, boss, if it is a cash deal, then gain loss calculation of target does not even require post merger MPS calculation. It is simply the cash paid to you minus the pre merger MPS. Yes or no? Yes. So, sir, how much is cash paid to you? 68. How much is your pre-merger MPS? 50. 10 rupee gain on 1 lakh 80,000, 18 lakh share gives you 1 lakh, 1 crore 80 lakhs rupees of total profit. That was question number 30. People in the class done for you. The C part of it means gain from acquisition, which means gain, means which gain? The total gain. What is the total gain of the acquisition called as? People in the class, it is called as synergy. So how much is the synergy from acquisition, right? That simple 25 rupee increase from 50 to 75, that 25 rupee increase on 18 lakh share is the synergy. 25 increase in the value due to growth of 6 to 8 into 18 lakh share is the synergy. That is the answer to C part. Question number 30th gets people in the class done. Come on. 32 is also a category question. You'll have to do it at your own on the similar pattern. It is similar pattern. Previously the growth is 7, now the growth become 8. All that is easy. 32 question is category A question, especially because in the C part of this question they give you good things. Why? Let me just guide you this question. We are not doing it, I'm just guiding you. A part of this question make you people follow the value approach. You need post-merger MPS, but using value approach, my value plus your value. But in the C part, they suddenly change the entire plot. They say, sir, assuming P ratio does not change, the EPS of the companies have been given. Sir, if EPS given and they say P does not change, isn't it that they want you to calculate now the market price using earnings approach? Why would otherwise someone say P is not changing? Why would otherwise someone give you EPS? So earnings EPS can help you calculate PAT, and PAT into P gives you market value. So in the C part, to calculate the market value, you don't have to follow value plus value approach, rather PAT into P approach, because details have been given in that manner. I didn't have an intent to solve question number C, but wanted to guide you in 32 question part number C. How has the situation got changed? Requesting your responses. 33rd is also a category question. You will have to do it at your own. Sir, now let me tell you. All 6 possibilities of M&A have been really done well, and in each of them we have learned maximum, minimum, gain, loss, whether exchange ratio or cash, everything we have done. That's so comprehensive, right? Cost of merger, cost of NPV, words are clear. Default assumptions, a summarization. Question is silent about the exchange ratio. Do it on the basis of MPS, already learned. Question is silent about the post-merger PE ratio of acquirer. Assume it to be the pre-merger PE ratio, already done. Question is not clear the gain loss to be calculated in terms of earnings of value. First preference is always gain loss in terms of value, already learned. Question is silent regarding maximum minimum to be exchange ratio to be recommended, on the basis of MPS or EPS, maximum minimum. Sir, look at the context of the question. If they give P ratio, maximum minimum has to be based on MPS. If the previous part asks you EPS, it has to be based on EPS. If the previous part asks you MPS, it has to be based on MPS. All those default assumptions have already been explained. It was a summarization. Last thing to understand is demerger and internal reconstruction. Sir, the question of demerger is an extremely easy question, just on a lighter note, giving you the explanation of the concept. Concept explanation is really simple. There is this company which has two divisions, division A and division B, right? I have some particular number of shares, suppose 5 shares, and there are 5 shareholders. The share represents the value, the share represents the claim over both the divisions, the profit of both the divisions, the value of assets over both the divisions, and everything. If the company decide to sell its division to a new company free of cost, company will sell to the new company free of cost a new division. So the new company will issue its share free of cost to the existing shareholder, as a result of which, sir, these shareholders which were holding shares of the existing company, they will continue to hold it, right? But the shares will now represent a lower value. It will not represent the value of division B, it will only represent the value of division A. But now the shareholders will have new shares of the new company, and that this share will represent the value of division B, which is now owned by company, second company. So overall wealth of the shareholder theoretically remain the same. Previously, one share was representing both the divisions value. Now two different shares are representing the divisions of both the values through two different companies. Could you understand what demerger is so far? Come on, requesting your responses. Hello? Last 5 minutes. In this case, everyone in the class, will the number of shares of this existing company fall? No, they continue to remain same. Their value will fall. Will the number of shares issued by the new company to the shareholder for free without purchase consideration? Yes, sir, because they received the division B for free without purchase consideration. Will the shareholders now have two types of share, original plus the new one? Yes. Last is the ratio in which shares are issued. Suppose company has right now 500 shares and company is planning to issue 100 shares of the new company. Do you agree automatically the ratio become 1:5? Against every 5 share in the existing company, one share of the new company will be issued, the ratio become 1:5. This much is sufficient for you to be able to solve this particular question 36, which is a B category question, as a question from study material. B category does not mean you skip it. It means you may not do it on the last day, right? So that is question number 36, people, to be done at your own. Last is internal reconstruction, category A question. Internal reconstruction is something you have done at C enter level. What this topic has, just giving you a context, that the company is facing financial difficulties. So in that case, there are different capital providers, right, whose capital is there with the company. And for company, these capital providers are the liability. So they are ready to forgo their claim. For example, equity share of 100 each. Now say, okay, let's reduce our claim to 25 each. Means company is now bound to pay only 25 rupee per share back. So do you agree on 6 lakh rupees, 75 is the amount of gain which the company has made because the liability has fallen. So 100 minus 25 is the amount of gain that the company has made on 6 lakh share, giving you a total gain of 450. So examiner actually give you these transaction which will make you understand how much is the gain company has made, like equity share claim reduced to 25, fully paid up from 100 to 25. That way different ways to generate gain is given, and then the utilization of those gains will be given. That preliminary expense you write off, previous cost PL and debit balance you write off, then the plant machinery may be right now 300, actual value is only 100 rupee, so 200 rupee return out that way. So first is you creation of gain, benefits, and then is its utilization, that writing out different things like provision for doubtful debt, preliminary writing off, etc. And then after doing that, you prepare a new balance sheet. Should be a doable question is not a particular concept to be learned for this. Question number 39 is based on the concept that you have learned in CA Inter. Boss. That was the last question from my side to be discussed in the class, and this completes every possible thing of this chapter gets done in this revision video. Are you people all satisfied, all set with what we have learned in this chapter, which otherwise look easy to a lot of students, but for us it was comprehensive and therefore lengthy? Come on, everyone. Yes? So finally back to the page where we started, and that was the start of the chapter. So thank you so much guys for being here. Let's meet back again in the next class, which is most probably tomorrow. All right. I'll see you all. Thank you so much everyone for watching up this lecture. As I said, if you feel the lecture was helpful, make sure you, live and recorded people both, make sure you have put in your genuine feedbacks in the comment section. Right? So a special thanks to all the live people for sitting here. Bhavya, thank you so much. Then Wine, what's your name? Thank you so much. Robin, thank you so much. Everyone else sitting here in the class live. Thank you so much, guys. I will see you all. Take care, everyone. Please, please, please take care. Bye, guys.